Good morning, welcome to Trade Live with IG. It is myself and the scariest man we could find for Happy Halloween, Scotty Byrne. You got to tell that story.
Yeah, just to illustrate the puerile and childish nature of a trading floor. Merlin Entertainments, which is actually not listed anymore again, I think they've gone private again.
Is it not?
Which owns sort of London Dungeon, Madame Two Swords, all that kind of stuff. On Halloween, you used to try to get as many orders as possible in Merlin Entertainments, because for some reason it was decided that that was the spookiest stock out there. So every time a sales trader would shout, "What's the price in Merlin Entertainments?" everyone would go, "Woo!" on Halloween. So,
And not just on Halloween, every single day.
basically, yeah, every single day of the year. But yeah, so if you think traders are smart, then they're not.
What was the hearing aid stock?
Oh,
So there was a company that did hearing aids, and every time a sales trader would say, "What is the price?"
yeah, it was a Danish firm, isn't it? I'm sure it was a Danish firm. I can't remember. I'll think of it.
Then the trader would pretend that they hadn't heard the name of the stock. So this, sorry, say that again. And of course, every now and again, a sales trader would completely forget what the joke was.
Exactly. All those years at university and all that money spent to make jokes that you make when you're 10 in the playground.
Yeah, sales traders don't go to university. What are you talking about?
Oh, yeah.
Right, so well, seeing as we're talking about the good old days, let's get up, because remember, this is Scotty's last day. So let's get up a picture of the old team. There they are. So if you've ever thought that diversity was a good idea, this was the height of diversity in a team. This was the Credit Suisse Emerging Markets 2016. And you see Scotty there. You had hair, Scotty.
It can reappear when I grow it out, but...
Or is it the pavement? Maybe it's the shadow of the pavement.
It could be the shadow. It's probably a street light shining on my head.
So we've got Mo Patel there, down in the bottom right. Then we've got Ben Sebley. Now, Sebley was a Royal Marine, went to Afghanistan. Then we've got Lisa Sanchez from France.
That's right.
Do not tell me how to trade, it is how I feel.
Do not tell me how to feel. Okay, I won't.
Then Kareem Osman there, he's now a big trader in Saudi.
Yeah,
and then
he runs Morgan Stanley, doesn't he, in Saudi?
Yeah, and then the three Russians opposite us, the two lads there, Dennis and Yuri from our Moscow office were across visiting.
Yeah.
So and
Natalia, of course, draped in fur, the classic Russian stereotypical sales trader, draped in fur and drinking champagne. So yeah, absolutely.
So and then we did have a Jewish member of the team as well, but he didn't make it that night, did he? Minbut Paul.
Oh, maybe yes. Yeah, his ankle was probably sore.
So it was, literally we ticked all the boxes, didn't we?
Yeah, what a brilliant photo. That takes me back.
Yeah.
And that was 2016, was it?
That was 2016.
Wowza.
Yeah. At which point you had been at Credit Suisse for 26 years?
Something like that, yeah, something like that. So that would have been 20... Yeah, that would have been 26 years, actually. Crikey. That's frightening, isn't it?
So we worked out today is the very first day that Scotty has left the job to go to another job.
To another job, that's right. Yeah, it's quite bizarre. I have been practicing for Monday morning. Would you like fries with that? So, yeah, hopefully.
Where is it you want to go, mate?
Yes, right. Yeah, exactly right. Yeah, exactly.
Right, what's coming up on today's show apart from the Scotty Byrne show then?
Yes, basically, yeah.
Well, at 8:15 we have the wonderful Hannah Mayfield. Now, I met Hannah for the first time at the Finfluencer Awards yesterday. Yes, the story will come up on that. But yeah, Hannah is a wonderful content creator, and she was also nominated for an award yesterday. And Luke Moore and her went to school together.
Ah, okay.
So Luke will be interviewing Hannah at 8:15 there.
What's Hannah's sort of area of expertise, like across the markets, or?
Yeah, across personal finance and how to look after your money.
Yes, I remember. Has she been on before, right?
No,
okay.
First time.
Maybe okay.
Yeah. Right, morning porridge, Scotty. What we got?
We've got the two Scotsmen and then the meat in the sandwich me listening to what's going on. I mean, it is going to be interesting, right? Because we're going to touch upon some of the features of the market this week and the mechanics. Because after we were talking about Wednesday about how far this market could go, and the answer at the moment looks like not very. But again, we'll see. And then there's some segment at the end.
You didn't know about this one, did you?
I did know about this one. No, I'm hoping that I have checked 3 times on Amazon that all the Gru outfits have been sold out. So hopefully I won't be getting dressed up for Halloween or anything like that.
That's good. I see producer Phil knows how to keep a surprise as well.
Yeah.
On the segment list of what's coming up. Goodbye, Scotty.
Yeah, exactly. It will literally be goodbye, Scotty, and that's it. Black screen.
So the Finfluencer Awards were yesterday, and no, I didn't win.
Travesty.
After all that, up for top macro, top economics content. No, I can't even say it. Never mind.
That's why you come second.
Exactly, yeah. So Pensioncraft, actually, let me see if I can find Pensioncraft.
Let's try.
He won it, and he is bloody brilliant as well. I must admit. So it was. There he is. Pensioncraft crowned top economics content creator, and I came second by 1 vote. So whoever's watching didn't press that button and vote the other day.
If I wasn't starting at the Golden Arches on Monday, I would be saying, right, let's use the Steve Jobs approach. If you've got eyes, plagiarise. You're going to tune into his show every day and to tune into what he's coming out with every day.
We'll have to actually, we'll get him on here. So his name is Ramin, and Ramin is fantastic. But just to give you an example of how good he is, his acceptance speech, because it's a proper kind of award ceremony, go up and he stood at the podium and he said, well, thank you very much, everybody. And to be honest, I don't know where I'm going to manage to fit this award onto my shelf at home.
Very good, very good.
And then he came up to me yesterday, and he came up to me afterwards, and I shook his hand, and he said, "Oh, were you nominated in the same category?" Pain.
Right. Okay.
Dagger through my heart, Scotty.
I know. I think a trolling campaign's going to start Monday.
Yeah. But huge shout out to Tom Slatter. So Tom is the guy behind Finfluencers. So a lot of the people that you see on the IG Instagram page, they were there. People you're going to see in the future, and then also friends of the show as well. We had Sammy from Up the Gains.
Brilliant.
Michael Taylor was there. Laura Ann Moore was there. So a lot of people, and Gabrielle.
Sounds it.
Gabrielle was on the.
And where was it? The venue?
It was level 42 up in the
NatWest Tower, is it?
Is it Leadenhall Tower?
NatWest Tower, is it? The NatWest Tower.
I think it used to be called NatWest.
But okay. I'll take yeah.
But yeah, really, really good. And I then went for dinner with the guys from 21 Shares.
Cool.
So that was nice. They've obviously just launched their crypto ETF.
Yes, and we did see that
for ISAs and SIPs.
That's right. Yeah, brilliant.
So really, really good evening. And feeling slightly the worse for wear this morning. So you're going to be.
It's a little snippet about the NatWest Tower. If you saw it from above, you see it's a slightly odd shape. It's actually the NatWest logo from above.
Oh,
those
that's
3 little sort of arrowheads, I guess you call them, if you remember the old NatWest logo. It's actually that from above.
And that was pre-crisis or after crisis?
I could not confirm or deny. I think that was still.
Maybe they sold it in 2009.
Yeah, exactly. Yeah.
Right, we've of course we've got Apple and Amazon to talk about. So let's get on to overnight action. Aha, Julian knows Pensioncraft. Good stuff.
Yeah.
So you can underline how good this guy is. Yeah, he's
100%. Yeah, listen, I'm sure there's lots of good people out there, as we know. Yeah, some people are more deserving than others, but there's lots of good people out there, but none of them are as good as us. But again, voting, as we see with successive governments, doesn't always get you the right result.
Oh, Rachel Reeves, what have you done? You are in trouble, my dear.
However, she got her estate agent to fess up and go, it was our fault, we should have done it. Because having let properties, it's your responsibility. You don't get you can't get an estate agent to take on that responsibility.
Yeah, the Times are really gunning for her there. Like, it's a crap picture, but it's like, but she's smiling. How could she smile after being told off?
She must be evil, yeah. I mean, that's probably like 10 years old, that picture or something. But
No, that's literally from.
was that really from
yesterday.
yeah, I mean, again, I did hear someone from the Labour Party this morning on the radio just saying, because obviously they're looking to bat back anything about sort of any criticism from the front bench of the opposition, and he said, well, now the Tories are calling for a resignation of the Chancellor after a simple administrative error. They basically better watch out. Is what he's saying. So,
well, it is absolutely classic politics. So, the good news for Rachel is if they wanted to sack her after the budget, then this is what they would have used. Right. So the obvious thing was she comes out in the budget, she increases the PAYE and increases taxes, and then they use this as an example to get rid of her, and taxes are higher, but she's the scapegoat. Right. Yeah. That would have been the normal politics playbook. The fact that it's come out now and that he said he's not going to do an investigation almost makes me think they've actually got a good plan for the budget now, and they've got it covered.
Well, yeah, I mean, if you remember, Bill, I mean, he may touch upon it again. He's mentioned it a few times, and in fact, it was on one of his, I think, on the Morning Porridge notes this week, where if you look at UK gilt yields, they've come all the way back from that crisis of the summer.
Yeah.
So it might be one of those ones where you tell everyone the absolute worst case scenario everywhere, and the fact that Starmer now is aligned with her, where he's saying more and more, we can't rule it out. Yeah, maybe. I think potentially we're probably as depressed as we could be ahead of the budget.
Oh, Scotty, because it's your last day.
Yeah, exactly right. But as a minimum wage worker from next week, I'm going to be campaigning for more support.
Higher minimum wage.
Higher minimum wages.
And pension.
And pension, exactly right.
You are the triple lock.
And as many cheeseburgers as you can eat. Oh no, that's a bit too late for that. No, yeah, so I think definitely we were saying about sterling, right?
Well, do you know what? I'm going to buy sterling on the back of this. So my hunch is that they're pretty confident they've got it together. So I have a 134 put, right? So I'm long a put at 134. So therefore, I'm short sterling.
I see what you're saying, right? Okay.
So I'm going to buy some of the delta against that short. 130, 139. I'll buy, £2 a point. Nothing crazy.
And I'm wondering then if we thinking that's going to play out at some stage, is a little trading footsie short. If you think sterling's going to.
Well, yeah, has. No, I don't think so, because if they get the country sorted out, then I would expect the FTSE 250 to go higher.
No. 100%,
and we've backed that on the the podcast as well.
Fair enough.
In our portfolio. But we can talk about UK for as long as we like. But the stories are Amazon and Apple, of course.
Yes, indeedy.
So let's go back to our Times newspaper and look at Apple first of all, because he's got away with it, and he's got away with. I say that because disappointing sales in China. And he still managed to beat revenues. So revenues 102.5 versus 102.2 expected, but he's talking a big game for Q4. And that's because he had some supply issues. Basically, they couldn't make enough phones for the demand.
Yeah, we touched upon that, didn't we? And again, he's also, as we say, this is where CEOs earn their pay, where he's talking about supply issues are going to get untangled.
Yeah, so look, he's done enough. No comments around AI, of course, but the stock popping higher after hours.
3 last night when I looked. I don't know if it's held back.
It's dropped back a little bit, actually.
Yeah, it's a little pullback. Yeah.
So, but had a nice little drop first of all, about 261.
That small shocker there. Yeah.
Oh dear,
oh dear.
And there it is.
Out on the keyboard.
Yeah. Now you can see the eagle eyes amongst you. I bought 80 shares up there yesterday at 283. And that's because I have a bit of an option structure on. And I've got an option structure on Apple and Amazon.
Okay.
And it is going to be an exciting evening, Scotty Byrne. I'm very much looking forward to the US hours. Not so much for Apple, but for Amazon. Wait until I show you what I've got in this Amazon.
Come on then, let's have a look.
Right. Now, thanks to Julian Wheeler, who came in last week and he said Amazon was his top pick for the results season. I am long 3 calls at the 232. So I own 300 shares for expiry tonight at a level of $232.50.
Well, I suppose if the weekly's expired, I mean, it's not triple witching,
Hey.
but it is Halloween. So yeah, looking out tonight. Okay.
So that's 8 p.m. tonight. Now, the problem is that I max out, right? And we're talking 300 shares of Amazon is, $72,000. So it's probably a little bit bigger than I would normally play. But at $255, I then sell those 300 and go short 300. So the reason you do that, of course, is to make the structure cheaper. So it's a structure. And then I was also short the puts at 207. So you can see it was 555 minus 2 times 69. Scotty, what's 2 times 69?
138.
Yay, there he is. And then plus the 103 from there. So that's 238. So I paid about $3 for this structure, right? And if we have a look at Amazon stock, where is it? Amazon stock is trading at $250. So if I can just get a nice little 1.5% rally, it means I make 10% on $72,000.
That's nice.
Now that would buy
$15,000. That's good.
69% of the time, you're right every time.
Absolutely, it works every time. Yeah. I mean, I would be surprised if they're not pushed a bit further.
Well, that's
into the close.
Every time a tech company beats it, it goes higher.
It always has a follow. I mean, especially because Amazon has been a little bit out of the headlines. I mean, if you actually look at Amazon, I mean, even on the hourly, I mean, this is not including. I mean, if I got my chart up, obviously this is not including the move higher. But I mean, that's in the last kind of week or so, that's pretty much lagged. I appreciate it's up 10 today, but that shows you the reaction function, and probably shows you where the gamma is potentially. It's got to be back to the upside, I would have thought, on the basis of that move last night.
I would imagine it's one of those kind of catch up. Just looking at Alphabet. Alphabet didn't actually, but that was of course due to the weak market yesterday as well. So Alphabet traded up around 287, 298, got as high as 298, and then dropped back. Very happy to see Julian saying that he bought some Amazon as well, thanks to Julian Wheeler. So Julian's going to be a happy bunny today.
Yeah. Well, seeing as he was seeing his wine dealer last time we saw him,
yes.
If you're going to buy him something, maybe get him socks or a scarf, because he probably doesn't need a bottle of wine, does he?
Yeah. Well, we got him a bottle of whiskey last time from
well, there you go then.
So he has already been messaged last night and said, "Is this enough for another bottle of whiskey?"
Oh right, okay. In that case, and if he's asking, he gets a crate of lager. Interesting. I mean, Amazon, if you look at the weekly performance in Amazon X today, it's only up 80 bips. So it's obviously up 10 today. But, I mean, if you look at that 1 week performance in the Mag 7, that's fairly mixed. Meta, obviously, that includes the weaker numbers. So, yeah, it's certainly got scope to go. I mean, it's properly lagged. Look at that year-to-date performance, right?
Well, the guidance was interesting. So if we look at the two companies together, Apple and Amazon, Apple raised guidance for the fourth quarter, right? Now, the street was at 9.8 billion for revenues, and they came out and said, we think it's going to be between 10 and 12 billion, right? So Apple have smashed their numbers there.
Yeah.
Amazon, however, the guidance was very much around where analysts' expectations are for the next quarter, for the fourth quarter. So they've had a huge beat on AWS. That's where it came from. AWS grew 20% year on year. That's the biggest rise since they've had in the cloud since 2022. So that's going to get the bulls going. But it wasn't because of the guidance. Apple's up because of the guidance.
No, I guess it's probably thematic, as you say, rather than the mechanical numbers, because they're now getting talked about as a robotics play, obviously with the changes that they're making in their warehouses and so on.
Yeah.
So again, yeah, I think it's a sentiment one. So whether it runs, as you say, mechanically in the numbers, as we were talking Wednesday, it's probably not going to change the EPS a great deal for now, or the PE. But however, the fact it's lagged as much as we've just seen there,
Exactly.
it's definitely into a Friday ahead of the long weekend. If there's any more shorts out there, they'd most probably want to close that one, though.
So let's do our official bit for social media, Scotty.
Yes.
Right. Otherwise, Sophie will tell me off.
Oh, crikey, okay.
So if we can get that up on the screen, guys, then you can see Amazon beat Wall Street estimates for quarterly revenue and its key. I'll start again, won't I? How many times have I messed this up?
That's all right.
Amazon beat Wall Street estimates for quarterly revenue in its key cloud computing arm on Thursday, but disappointed with its weaker retail business as companies continue to spend relentlessly on artificial intelligence. It also raised the amount of money it's going to spend on CapEx for AI. But that didn't stop the shares. Oh no, up 10% overnight, with huge cloud demand helping Amazon ease the pressure from the weaker growth in e-commerce. Amazon Web Services reported 20% annual rise in revenue in the third quarter to September, beating estimates of an 18% increase. Net income for the 3 months to the end of September was $21.2 billion, compared with $15.3 a year ago.
Sounds good to me.
Got it in the can. Get that cut. Get it out on YouTube. Get it out. Hey,
Exactly. It's not like this is live. It was all recorded last night anyway, so.
Let's see Pension Craft do that.
Exactly.
He'd do it.
He doesn't walk around the streets making videos, does he? Like the real McCoy.
No, I think he does, Scotty.
Oh, does he? Oh, okay.
Well, he does now. He's got his own fancy studio at home.
Oh, very nice.
And do you know what will really get you going?
Go
He's
on.
ex-UBS.
Oh, good. Well, he's obviously a bad guy. He's a bad guy. As Trump would say, he's a bad guy. Must be a bad guy.
Now, what was your story about Trump overnight? That was a good one.
Yes. So there's a bit of a sado I am. I'm on the White House and POTUS Instagram feed, and he seems to appear. He's obviously flying around the world. As I said to you, he was termed in the Times yesterday that he's flying around Asia like a mafia don, shaking down the neighbourhood for money. But yeah, he was. They were obviously flying on Air Force One at some stage yesterday, and the plane was shaking because there was a bit of a storm, a bit of turbulence. And he was standing there going, "Oh, look, I'm shaking. Some people are going to say I'm not fit for office." And I was just like, he needs a Sophie. He definitely needs a Sophie, doesn't he?
Nobody can keep that man under control.
No, absolutely right. Absolutely.
Right, it's 7:53, Scotty. What
Already?
else are we going to
my
be
goodness
watching this
me.
one? Oh, Glaxo. Whoa, that's saved me. That has been a real treat.
Is that right?
So Glaxo, remember we bought it at 16,
On the upgrade, yeah. Was it the upgrade? Yeah. Was that Wednesday?
That was Wednesday.
1679, year I was born. There you go.
I don't lie, that's when you graduated.
Yeah, fair enough, yeah.
So we'll be watching that one on the open.
Nice.
You're a little bit worried about the breadth of the market, aren't you?
Yeah, market breadth. It's one to look at just as a quick check. So when you're looking at any metric like this, so we'll just remind ourselves of where the SPY. Yeah, well, I know I need to get the chart up. It's not ready yet. Honestly, right? Okay. So yeah, so basically, let's go back to the daily. So at the moment, I try to take. Oh my goodness, look at that. That is horrendous. Okay. So at the moment, I've only got two simple indicators, which is the 50 down the 20-day. Because at the moment, market's in an uptrend, so we only need to look at the breadth really for the 50 down the 20-day.
Okay.
Otherwise, you get a bit too bogged down. But when we look, so here's the breadth for the 50 and the 20-day. So this is advanced decliners on the NYSE.
Right.
So basically, where more stocks are going down than going up, it's a yellow. It's exactly. Yeah, it's a down. So I mean, if you look where the S&P is sort of levitating above the 50 and 20-day, it's in the uptrend. It's fine. It's looking at, but I mean, in the last 1, 2, 3, 4 sessions. So this week, despite the fact we had the breakout on Monday on the good news of China trade war, breadth is dropping away. I mean, look at the 20-day. So that's the shortest term measure.
Okay.
And the nearest measure, that is a very significant drop. And then look at the spike for the put-call ratio on the bottom right as well. So again, it could just be some caution.
Well, no, look, if anybody wants to do this exercise at home, look at the size that NVIDIA is in the S&P 500. So it's the high nines, isn't it? 9.8, 9.9.
Yeah, I think four stocks are 23% or something bonkers or whatever it is. Yeah.
So take NVIDIA's move out of the S&P this week, then take Alphabet's move out. Right, Alphabet's about 4.5%, I think. Because you've got to do the A's and the B's together.
Yeah, sounds good. Yeah.
And then take Apple and Amazon out. Right, so you've got the S&P 496.
Yeah.
That is going to have had a shocker of a week.
Well, so if we look, that lighter blue line. That's effectively X the mags. So that is the equal weight ETF. It's obviously including mags, but equal weighted. So that's the S&P equal weight ETF. So yeah, you basically got a differential.
So can we go in tighter though? What's the 7-day move on that?
Yeah, we can shorten that down. Let's look at the hourly.
So
you can see. Look, the last. So let's get rid of that drawing because that's just making it messy. So look, you can see here, since this break higher a week ago, so this is an hourly chart, so you get 8 bars for a day. You can look at the divergence this week again. That's a very similar.
Do we have that in percentage terms?
Yeah, so that's expressed here. So effectively S&P is up 4.3% and the equal weight has dropped 30 basis points. So you're talking about almost 5% differential in the price performance in a week.
Right. Well, that's why I'm short Russell. I'm short the Russell.
Well, I mean, again, especially now, he's poured cold water on the potential of the rate rise. And as we said about Main Street, numbers for Chipotle, the famous food poisoning recovery story, where they were down, 18%, something like that on numbers, and citing inflation in the high single digits.
Sorry, people don't want to spend £14 on a burrito that they take away in a small bag.
No, exactly. If they were traders, they'd be spending 25, but not everyone's a trader. So yeah, it's
go to Greg's.
Yeah, exactly. Yeah, even traders are going to Greg's.
Right, we're going to have a quick 1-minute break. Then we're going to come back, and do we have some good news from the London Stock Exchange? See you in 2 minutes. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris C.J. Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris C.J. Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Right, we've got 30 seconds until the bell then. So just to report, Nikkei's really strong overnight, up 1.9%. That's on a dollar yen at 154. So we've been seeing it in the high 152s. Yen has weakened. 154, that has shot The Nikkei higher by 1.9% to 52,000.
Yeah, and there's
Hang Seng, China weak though. Weak China, Scotty, down 1% with tech weakness.
Had a bit of weak eco data out this morning as well in China. I'll have a look at that in a sec.
And here we are,
Double
the
for
London
Halloween.
Stock Exchange opening bell. And it's Friday. Where are we then with these stocks? It's been a long week of reporting season, but now we are here on Friday, Halloween. Let's see what is going to spook the market this morning. Well, it's WPP down 2.6%, so poor start there. Burberry down 90 basis points and BP weak as well. Scotty, what have we got on the upside there? Who's the winners today?
Nephew, yeah, drug. Oh, it's interesting. Smith and Nephew, bit of a. That's quite a mixed little tick higher, isn't it? That I think you could say that's probably a tentative little mix, isn't it?
Come on, Scotty, for our blind viewers.
For our blind viewers, Smith and Nephew up 0.5%. Travis Perkins, Tesco, Diageo, Aberdeen, all up a little bit. Perhaps a chink of light here and there in some of the consumer names. We've just got a few of those just ticking up. Marx's, Kingfisher. Just having small gains on the day. Rolls-Royce seems a bit stuck as well, unchanged. That probably needs results again just to give that a little bit of a push, which I believe are a little bit later in November. But a pretty muted start. But yeah, interesting to see Smith and Nephew leading the early charge. You don't see that very often.
It is. I'm not joking about the blind viewer. So we actually had a guy came up to me at Sodsnoff's thing, and he said, I just want to say, you probably don't realise, but you reading out what the market's doing every morning, because I can't see my computer.
Well, enough respect to that person then for still following the markets.
And trades,
massive respect.
Real proper
Yeah, massive respect.
So yeah, good to know that my voice is better than a robot's that he's usually has reading the stuff.
Absolutely, yeah, absolutely.
So, and I say that because my own father was blind as well for the last 8 years of his life, so the guide dog used to have to trade for him. HSBC down 88 basis points. We've got Burberry, we said, BP, so it's just a little bit of weakness across the board. Let's see where Glaxo is, because I must admit that has that's most
probably what, as they used to say, wildly unchanged.
Right.
Oh, there we go, small up. Yeah, there we go.
So I'm going to take half the profit in Glaxo because that has paid for a nice weekend.
There you go.
Look
at that.
That's decent. That's definitely more than I expected from that Glaxo trade. So
it's almost like you know what you're doing.
Well, clearly not. Maybe Pension Crafts got 3 times as many shares that I did.
Listen, if you're at the top, the only way is down, baby.
Right, let's have a look at Europe then. So we've got Anheuser-Busch, the InBev, the alcohols are going a little bit higher there, 1.9%. As is SocGen. Puma, did Puma have a profit warning? Because that has had a shocker of a week. Cuts 900 jobs. Confirms guidance, but sales continue to decline. So weak numbers there. I wonder if this is what the potential acquirer was waiting for.
Just to swoop, yeah. I mean, as we were flagging on Wednesday, I mean, that was at 56.5 PE on Wednesday, so price for perfection.
Yeah.
But also with the bid spec. So,
I'm going to have a little play there. Just 400 shares to buy at 18.95, just in case we get something in the weekend press about a potential bid.
Okay. Thank you for completely destroying my lecture about knife catching from Wednesday, leaving me.
All right, 18.85.
Zero left score. Boom.
So there we go. There's Puma. Who else are the winners in Europe, Scotty?
SocGen, interesting, having a little bounce back. Airbus, Mercedes, so a slightly sort of industrial auto tilt this morning, which have been laggards. So yeah, it just feels to me that that's just an early little bit of perhaps position trimming, because we see this now and again, the runaway leaders underperforming and things that have been bad have a bit of outperformance, because you see, look, Mercedes, Porsche, Volkswagen, Stellantis, all ticking up, airlines ticking up, Heineken up in sympathy with InBev.
Yeah, we don't really have an Amazon or Apple read through in Europe, do we?
Well, no, this is the problem, isn't it? I mean, ASML potentially, but that's not really a. And this is the whole argument. Although again, I did see in the press this morning where they were talking about how European equities are so hated, but however, macro's ticking up, the checkbook's open, and these indices are at highs like everything else. But just the stocks are just really hard to get excited about on a sustained basis, unfortunately, aren't they?
Well, talking about not getting excited, we had the ECB leaving rates unchanged yesterday. Lagarde, you never really feel like she's just not inspiring.
No, I mean she's the safest of safe pair of hands, right? She fits like a round peg in a round hole with the politicians because she's an ex-lawyer, right? Yeah. So yeah, I mean after Draghi, I'm sure some of the EU politicians are probably having kittens in the background when he went, "I'll do whatever it takes," that kind of thing. But yeah, she's as you say, she's not the kind of inspirational.
Yeah, she's not a Powell or an Andrew Bailey. Adidas.
Relative levels of excitement with those three. Yeah, it's like, which one would you want to be on a plane with to Australia? the dog.
Adidas has had a bad week as well. 166 there. So really Nike back down at $65, Adidas 166, and Puma. So that really, that is telling the story about the breadth that we spoke about earlier.
The consumer, right? The consumer.
Yeah. Right, of course, it is that time of year that we have the all sessions open as well. So let's go straight to the all sessions.
Yeah, look, just as we thought.
And Netflix, at last, Netflix is actually getting a bit of a move there. So we got a nice position in that as well. For once, I've actually got stocks that are going up.
There we go.
The top four in the leaderboard there I've got exposure to.
That's interesting, isn't it?
So let's see how those do today, because Oracle has been a shocker of a trade for me. I've got that from, I think, $300, sorry. Now trading 262. And then Nvidia. So we've got Jensen presenting as we speak across in South Korea. He's done big deals with Samsung and Hyundai this morning, hasn't he, Scott?
I mean, his legal team must be driving around in solid gold Lamborghinis. The amount of documentation they've had to draft for all these deals is striking. He probably wakes up in the middle of the night and thinks, who haven't I bought yet? Or what haven't I bought yet? Yeah, I mean, again,
but the question is, who hasn't he bought yet?
Yeah, and so that whole land grab thing that we're talking about, and I don't know if you talk to Julian, he still uses the acronym of his milkman showing up with 3 pints at the door every day, and one day you're not going to need so much milk. But I mean, for now, the strategic partnerships, and then, I mean, again, I just wonder how much is done in conjunction with the US, because you look at these rare earth acquisitions that they're doing, the power networks that they're doing, he's obviously got a degree of backing. I mean, if Trump says about Nvidia and their super duper chips,
I don't think we're not worried about Nvidia's capability to pay though, because he's thrown off billions and billions. So that's fine. It's OpenAI. OpenAI's got $1.4 trillion of liability.
No, I completely agree. I think Nvidia, though, in particular, they've clearly positioned themselves alongside the government, who are going, right, let's get rare earths, let's get power, let's really go for this. And we're here, sitting over here, thinking, has the Chancellor filled in a piece of paper for a local council?
It's true.
Letting her house out, right? And it's just, at the risk of sounding like a broken record, you think the things that are happening around the world where we should be positioned to a degree for taking advantage or at least having involvement. I mean, it's a month since they signed those supposed, mega tech deals. I mean, it's what Jensen spends in a morning on some company you've never heard of. So
what the very least that Rachel Reeves can do is hands off our investments. Do not touch dividend tax. Right? In the budget, Rachel Reeves, please, hands off our investments. Do not touch dividend tax. Do not touch capital gains tax. And then the ISAs as well, right? If they cut the cash ISA, encourage saving in the UK. Try and, push for better education, financial literacy. That's what
Absolutely.
a lot of last night was,
Exactly. I
was
mean-
about. There was 65 of us there that were nominated for awards, and the underlying theme is improving financial literacy across the nation. So you
No, I
can,
completely agree. Unfortunately, those events like last night get very few inches in the newspaper and on social media news. What does get is another huge fine for these finfluencers who are selling these, signal products and whatever. It's almost like
the
a
dodgy
show.
ones.
It's almost like a show like this needs to be aligned with like an exchange or get some sort of official recognition from an exchange, perhaps.
well, that was beautifully lined up, sir. Eh? You should be
Oh,
doing
I was
this for a living.
just chatting. I was just chatting.
So there is a wonderful chap called Will who works for London Stock Exchange, and we're having a chat after the awards last night. He was there, and he's watched the show, and he's trying to push for the opening bell segment to have an official relationship with the London Stock Exchange. It's really hard, of course, because they there we go. They can't seem to show favoritism between the companies, right? Because there's obviously other companies in that are listed on London
Sure.
Stock Exchange as well.
Sure.
So it is a hard one to get through compliance, to get through the media department, but he is trying his best. So one day we could have the opening bell
But I
officially.
mean, why not just have effectively a sort of list of accredited education platform providers, and even if it's 3, that gives choice, because you can't throw all your weight behind one institution
No,
or
of
one
course.
organisation. Of course you can't.
But then the others don't do a morning TV show, so sorry.
So exactly, either you do or don't. And I think I can fit in between my shifts at McDonald's. If anyone's out there looking to pay a fortune for an incredible presenter in between shifts at McDonald's, then let me know. But no, it has to get away from the sensational headlines around, these finfluencers. I mean,
Yeah.
why do people keep falling for this stuff, right?
Yeah.
Right, and it is.
Especially the crypto lot.
Well, it's just all this stuff, and I just think if they got a chat with the Exchequer and they just said, listen, we're going to identify 3 or 4 firms, they're all listed, so they're all fully audited, accredited, FCA, etc., and we're just going to encourage people to just use their platforms, not to say you have to, but just encourage people to use their platforms.
Yeah.
And just to say, look, you should be checking this out. We've done the due diligence.
Yeah.
We've looked at the product.
Well, I tell you, the person who has read that FCA document on content creation the most is Tom Slatter at Finfluencer.
Right.
And the guy who organised the awards. And he is so good. Like, I have learned a lot from him
Yeah.
on
bet.
exactly what the FCA want, what they're looking for.
100%.
And to continue this chat, we have a fellow Finfluencer coming up, Hannah, after the break, coming up with Luke Moore, who they know each other well because they went to school together. And so we'll hear more from Hannah on what she thinks about that side of Finfluencer.
Absolutely.
And the helps it can make, because her, I guess, I'm Rich Macro Trades, and hers is What is Wealth. So, much better name. And maybe I should ask Hannah a bit more about some marketing and branding ideas for my own page.
These conversations never hurt. The more conversations you have, the
Yeah.
more chance you have of... Right, time to guess the chart.
It is.
Maybe my last one. Oh, there's a special song apparently. Hopefully it's set to the McDonald's theme tune. But it's a guess the chart. Let's see if I can actually get this one as a farewell guess the chart.
Are we going to listen to the music? I fancy it might have Scotty's name in it, perhaps.
No.
The song is called Goodbye Scotty, and it's a Canadian stock.
Canadian, blimey. It's only about 4, isn't there?
Luke Moore and Hannah coming up after the break.
Ooh, yeah. Let's roll on. Roll on. You came in cool from Credit Suisse. Years in the game, you knew your piece. Rich said, mate, I've got a plan. Next thing you Scotty. Roll on, my friend. You gave us drive right to the end. Mornings breaking, futures fly. You're still the spark beneath that sky. Goodbye, Scotty. Roll on, my friend. From DMD to the London line, you taught the trade and kept it fine. No ego here, just class and wit. When shots got wild, you handled it. Phil cues the sound, the feed runs tight. We'll toast your name in the city light. It's not a close, it's a turning page. You're stepping out, center stage. Now the crew keeps time to the groove you made. We'll keep that rhythm from the days you stayed. Goodbye, Scotty. Roll on, my friend. The road don't stop. It just bends. You kept it true. You kept it clean. The steadiest hand we've ever seen. Goodbye, Scotty. Roll on, my friend. Oh, the market hums your song tonight. Every tick's got your guiding light. You taught us calm, you taught us grace. Now it's your time, take your place. Goodbye, Scotty. Roll on, my friend. The screen still glows where your name's been pinned.
Okay. Good morning and welcome back to Trade Live with IG. I'm joined by a good old friend of mine, Mrs. Hannah Mayfield.
Yeah, that's me.
That's you. Welcome to our studio. How do you think it is?
Thank you. Yeah, it's good. I'm like looking around. It's all going on, but it's good. I'll get used to it.
Yeah, exactly. It takes a bit of getting used to, like the lights,
Yeah.
the screen, making sure that everything's not out of place on the screen.
I'm like looking around. I'll try and
Try and look a bit.
like
Okay,
stay
fine.
normal. Yeah.
Firstly, right, guess the chart. We were, of course, looking at Shopify there. Congratulations to anyone that got it. Do we have any winners in the chat? Gavin Ackers, well done, Gavin. Shopify, it is a, yeah, I was looking at this stock for myself probably about a year ago. This whole kind of AI push to e-commerce, and did nothing about it. Absolutely nothing about it. So, Hannah's joined us, and it was a chance connection actually. You sent me a message on LinkedIn. It was like, hey, I'm doing the Finfluencer Awards yesterday.
Yeah.
And was ultimately trying to get an intro to Rich.
Oh, well, I kind of like knew. I guess I went last year and met him a bit there, but I just started using LinkedIn and then was like, oh, there's actually loads of people, you know, that I hadn't spoke to in a really long time who were doing not similar things, but maybe like, you know, not wildly different what you do here, I guess. It's still making some financial content and yeah.
Good. Well, so your company is What is Wealth?
Yeah.
And so you're a financial coach.
Yeah.
Perfect. Do you want to tell us a little bit about how it all came to be that you became a financial coach? Like, what was it that got you into the world of finance?
Yeah, so it was really life curveball. I used to work in fashion. And then, oh yeah, my website just
It's
came
a
up.
nice website. It is. I got to say, it is a beautiful website. by the way.
Yeah, my friend designed it actually for me, so
It is
she'll be happy to get a shout
absolutely-
out.
It's absolutely stunning. What should we give her a shout out? What's her
Yeah,
name?
Hannah May Studio.
Hannah May.
Another Hannah, yeah. I have a lot of friends at Hannah's and Anna's, so it all gets a bit crazy. But
A little bit. This is my favourite part. I thought investing was a boys' club. Let me woman-splain.
yes,
Love that.
because I think women especially have felt pretty excluded, and my whole journey into investing was I started my career in fashion. I had no idea about investing money, just like wasn't in my sphere, and then when I was 22, my dad died and I received some money and I just realised like I have no idea what to do with money. I have no one that I have these conversations with, didn't have any base of education to kind of know what to do, but I knew I needed to figure it out. So I kind of started teaching myself, learning about money, learning about investing, different assets, like how they all work together, just even basics about how the economy works. And inflation is always actually a goal of the Bank of England, and like just all these things that I didn't understand how the world worked behind the scenes. I guess you're kind of just told maybe to like get a job and I don't know, buy a house and just kind of.
Yeah, it's funny. So I've got like all my buddies, and I've always thought that if I'm in finance, people will like kind of ask and figure out what to do with their own money. Because you know, if you're giving up a day job and you're giving up 8-9 hours of your day every single day, you're effectively exchanging time for money.
Yeah.
The whole point is how do you use that to then go and either live, save, invest in your future. You've got to use that resource in a certain way. The amount of people that sit in cash is crazy, totally crazy. And you know, even just the thought of what is an ISA? How do I use a tracker fund? All these different things are so kind of alien to so many people.
Yeah.
In our little world of kind of this building and kind of the audience that we have here, it's just these things are super simple. But to the average person, it really isn't.
Yeah, I always say it's kind of like learning a different language, because it's like ISA, SIP, it's not intuitive. You just wouldn't know that unless you put some effort into learning it or had happened to be in the industry or have conversations with people. So it's something you kind of have to, I get why people feel like, oh, maybe I'm stupid, but it's just literally a different language. You have to learn what all the words mean and how it all fits together.
But also the incumbents aren't particularly helpful. You know,
Yeah.
I find whenever I look at a different website, I mean, and ours, you know, is getting worked on and all these different things. Everyone wants to just advertise fees. You don't even know how those fees are taken.
Yeah.
You know, platform and tech, when you kind of need to teach the act of taking that first step as opposed to, you know, all the technicalities around the product.
Yeah.
You know, we were looking at kind of how our brand sits within the world, and it's just this sea of grey and blue and navy, and it is fairly intimidating for one, but also fairly male centric. I completely agree with your rhetoric on the website. It totally is. We need to find a way to be much more open and able to talk about things. And so it's great that you're doing that. In your experience, what do you think it is that holds your audience back, or kind of predominantly women back, from making that first step?
I think it is just there aren't loads of spaces to go to, or maybe you don't have people in your circle that are having the conversations as much, and then you kind of just wouldn't know about it. I think people also now understanding more, like, I think there's been a big shift maybe in the last 5 years as I guess more content is coming out. People are like, oh, I should be investing. So I think that kind of like that step has kind of happened a bit where people are like, oh, maybe I should be doing something with my money. But then the next part is getting stuck on, like you said, you go on these websites and you're like, I just feel more confused because I've gone on them and I don't understand some of the language, or, you know, a lot of people think that maybe an ISA is a type of investment, not an account type. And it's just those kind of misunderstandings that then make it, you kind of like, I think people put it off as well.
Yeah.
Sometimes people are like, oh, I'd love to do that, but I'll do it like next year, or I'll do it when I have more money. And it's really because it is a bit intimidating at the start if you don't have someone to maybe guide you through it, or you've never been taught it.
I remember the first time I put an investment on.
Yeah.
I remember exactly what the share was. It was Sentiment Egypt at the time, and it was I'd read in an article somewhere that, you know, this gold mine in Egypt was going to be the next biggest thing. And I remember I think it was a couple £100, and I put it and I invested in it, and I was like, oh my God. And I stared at it every single day.
Refresh.
Every single minute of every single day. I was like, oh my God, because this was my first entry to kind of risk and finding out what risk is. And I'm like, you know, I could lose money doing this. Why would I lose money? That's just the worst possible thing. And I was intimidated, and I'd had, you know, a couple of years working in a place like this. Yeah. When it's your money, it's a completely different place to be.
Yeah, I think people get very paralysed because it's like, I don't want to do something wrong. And it is hot. Like, everyone, you know, you can't predict the future. So it is easy to think like, oh, I could do something really wrong here because I don't know exactly how this is going to pan out. Because no one has a crystal ball. No one knows exactly what's going to happen.
No, of course not. No.
So that obviously makes it just scarier anyway. You don't have complete control. It's not the same as savings, right? When you kind of like, no, I'm getting this, it's set.
I suppose it's the element of it not being guaranteed.
Yeah, exactly.
But I suppose there was obviously strategies to do that, and kind of to kind of move the odds into your favour a little bit. So if you were going to sit and you know, a new client comes to you, or a new person comes to you and says, right, Hannah, what do I do? Where would you typically say, right, step 1, step 2, step 3? Kind of how do you go about helping people through that journey?
I think a lot of it is figuring out the different places that you could put money, like what are the pros and cons of all the different types of assets and things, so you can actually compare them. Figuring out like, how much you need in cash first, then, okay, is there more I can do for like my future self? Start putting that towards, and then where do I want that future money to go? Like, how do I want to split it up? Do I want it to be in stocks? Like, what kind of stock market investing strategy might that be? Like, should I go for property or, So kind of a gold is obviously really big at the minute, or, well, had a little drop, but in general over the last 5 years. So it's kind of understanding what the pros and cons of all those are as well and putting it together if you've got a bit more cash that you're sat on. But I think for a lot of people, I do think the stock market sounds really risky, but it is super liquid. You can get your, you can get your money out if you need it. So there are a lot of pros to it as well.
I was having this exact conversation with a friend the other day. And I think we're kind of hardwired to think that property is the only way that people make money. Or like, I put all my money in my house. It's exactly what my parents did.
Yeah.
And we were kind of having a heated argument about, he had a bunch of cash, and we went to uni in Nottingham. And so the whole point is he was like, right, if I can buy a flat in Nottingham, I can rent it out. And and we got eventually to the point where it's like, what is your ultimate yield that you were that you're going to get to? And it came out something like 4%, right? And that's a big lump sum investment. Take away all the layers of fees and management agents and all this stuff. You came out with 4%. And I said to him, I was like, you can open a cash account now and get 4%, pretty much 3.75, 4 with us. You can find a way to get that same amount of money. And you're right, you can get it in and get it out straight away. So why bother with all the other hassle? It's as much an education piece around what vehicles exist and what the outcome is, for what degree of risk, and that massively becomes part of the conversation.
Yeah, exactly. Because I think, like, if I think about my own journey, I used to have no idea how much different assets or different stocks or whatever made. So when I realised like that, you saying like, oh, you can make 4%. If you didn't know, okay, well, whatever has gone up by 8%, 10%, 15% in the last year, you can't actually compare it. You're just thinking, which makes sense with the property thing as well. You're like, oh, I've lived in a house. Like, I've probably rented a house at some point. So it's more intuitive, I think, than doing all that big comparison between everything.
And you can see it as well, right?
Yeah.
You can
It
literally
feels like
see
safest houses, it's like the phrase, right? And
Yeah, except if you're like me and I've got the blooming cladding on my building, in which case my flat's worth technically 0 at the moment.
Yeah, that's stressful.
Which is a pain.
Yeah.
But yeah, it's about, I always find kind of doing the job when we talk to clients, it's about trying to figure out what the ultimate need is. What is motivating this person to have a conversation with you, what are their goals? And actually people just say, I want to make money, but actually that's not really the right motivation. It's, how do I build a portfolio that is structured to your risk appetite to then go and get your outcomes?
Yeah.
Yeah, it's as much about questioning and figuring out what they mean to then go and put the right solution in front of them. I imagine that's a lot about what you're up to.
Yeah, and it's kind of figuring out, I guess, when you need the money as well, right? Because if you have a really long time, maybe for your pension, if you're a bit younger, you can do different things and maybe something you might want in 5-10 years' time.
When we were talking before this, you told me something fascinating about lump sums, specifically and I'd never seen this perspective before, from a women's perspective, getting a lump sum. Can you just explain that? I thought that was really interesting.
Yeah, I think there's a lot of chat in the finance industry about, they're calling it the great wealth transfer, where we were talking about property, right? The kind of boomer generation, they maybe have a lot of equity in these houses and then things are starting to get passed down now. But then kind of what that means is people are maybe inheriting money or maybe have a divorce or something, like you have a lump sum of cash, but if you kind of don't have any financial education or experience, it's quite intimidating to be like, oh, I'm now responsible for this money. I don't know what to do with it. Like, I don't know the different types of things, but I know I need to be doing something with it. So it's actually quite a stressful place. I work with a lot of people who are in that position as well. Which it sounds like a nice problem to have, right? You're like, oh, I've got all this money, I don't know what to do with it. But it's a big responsibility, especially if it's come to you from like these horrible circumstances, and then you don't really know what you're doing, and maybe you can't find someone to trust, or it's a big process people have to go to. And I think some people then avoid it because, it's not putting a small amount of money in something. You're like, oh, well, if it goes to 0, like I would have spent that, going out for dinner anyway. It's kind of like, this is someone's whole life's work maybe that they've worked towards over decades, and now I'm responsible for it. I don't want to get it wrong.
I suppose at that point as well, it's as much about the price that you pay and timing. Like I've always thought, you look at the stock markets, they typically make highs each year. Chris Beecham, the chap that works with us, has always said that making an all-time high is actually a pretty good buy signal. Because if you've got strength and if there's momentum in this market, if you're looking at tracker funds and you start with a super diversified Vanguard world, iShares world, whatever it might be, GDP growth exists so that economies grow. So typically things should go up most years, right? Obviously it doesn't always happen. But people go, I've seen a chart go from here to here. I don't want to pay that.
Yeah.
And if you're getting a lump sum, that can be a really intimidating decision. So how do you help people with that?
I think it's just realising that there's no best time as well, because you could say it the other way. If things were really low and drop, you'd be like, oh, things are really bad right now. Like, I don't want to take any risk and buy now. If things are at the top, you're like, oh, I've missed the opportunity. I wish I'd have done this 2 years ago, 5 years ago. But it's like, yeah, but it's just not helpful to look back and be like, I wish I'd have put it in earlier. Yeah, like I wish I knew about this when I was 20, but I don't. So I'm just going to have to like move forward now and keep going.
Yeah.
So I think it's understanding that actually, if you have the cash, in general, there's like loads of studies that have shown it's probably better if you just put it in when you have it, rather than trying to time it. If you're doing that like long-term kind of tracking, diversified, simple strategy. So I think it's understanding like, yeah, but if things did drop, you probably, like the news would be really bad. Like everyone would be freaking out. Like people maybe would be losing their jobs if it was in a really bad economic situation. So you probably wouldn't feel as confident as you imagine you would now anyway.
Yeah, massive. We did a whole piece on that. You know, the absolute kind of fear of missing out, FOMO, the kind of huge psychological impact of loss aversion, and just this like how big a motivator it can be. And there are also loads of studies done on the number of negative articles written versus positive articles.
Oh yeah.
And it was in the context of, I think it was the start of the Ukraine war, and it was like negative articles were like 10 times more voluminous than positive articles.
Yeah.
And you think, well, which ones are correct? I know which one gets my attention more, and now I'm going to be biased to thinking everything's going to get worse all the time. But it's trying to figure out how you sit with your own decision making at that point that is always very difficult. And I've done it, you know, in April, tariffs. I saw everything come down. I was like, right, this is literally the time that I should be buying.
Yeah.
But I'm scared.
Yeah.
And it's you can't get away from it.
Yeah, exactly. Either way, you're going to feel it.
Yeah.
And yeah.
So I suppose that brings us around to in your world, when you look at risk, what do you consider to be more risky? The risk of doing something or the risk of not doing something when you're talking to people you work with?
I think what was a big switch for me and a good starting point for people is I'm like, okay, well, your pension is invested. Like you're probably already an investor, like your private pension. And then you're like, oh, okay, well, the government like really encourage us to put money into our pensions. They give us tax top-ups to do that, and that's invested. So maybe that is actually a sensible long-term thing to do. So that was kind of a way that helped me, and like, I think other people are like, oh, okay, maybe it isn't this really risky thing. And actually, I think when you understand inflation properly and you kind of zoom out, I think the example I often give is in 1975, I think the average house price was £10,000.
That's actually insane. That's
and now like
crazy,
50 years later, it's 250 or 270. I was like, imagine if you were in a time machine and you were like, in 1975, you're like, okay, I'm going to keep that in the bank. And then you kind of fast forwarded to today, you think you can buy a house and you'd be quite shocked. So it's kind of like, okay, actually, when I zoom out, I can see what's happening. And I think because the last few years we've had more inflation, people are like getting it a bit more, because obviously people are feeling it every day. Like, oh, my money isn't going as far as it used to.
Yeah.
So it's a bit more tangible than I think in previous years. People are like, oh, okay, I see that maybe I need to do something with cash.
Yeah,
I have more of it.
The way I've always tried to, from my perspective, tried to justify that pension piece is that if you're doing it through a SIP, when you're, I don't know what the age is at the moment, but you can draw down a certain percentage of your pot, tax free. The rest of it you're going to get taxed on, and you've got to be careful about how you withdraw it.
Yeah.
And I kind of thought it's like the government is riding on the same trade as you, because they're going to give you tax relief today, but in 20, 30, 40 years time, they're going to tax you on the way out. Pound for pound, they're probably going to earn more off you on the way out. So they're actually kind of doing the same sort of trade.
Yeah, I guess it's always changing as well, the pension. I think also people are really can get quite nihilistic about it and be like, oh, what's the point? And it's all going to change by the time we get there anyway. But it's like, well, I don't really want to risk that either. Like, I don't want to risk having a really uncomfortable retirement. So
yeah.
So
how would you? So if you had a new was it clients that you work with, kind of coachees, mentees? What do you?
Yeah, I do quite a lot of different things, but sometimes I do work one-to-one with people. Yeah.
So if you had someone that was new, where would you get them to start? What would be the first thing you do with them?
I think it is understanding like your future. I'm very much like money as a tool for your life. Like I don't really care about it for the sake of it. It's like, okay, what does that afford you? What are your goals? Like, what do you want your life to look like? So I think that's a really good starting place to be like, yeah, what do you want? And then how can your money support you to do that? And just putting it in the best places to give you the life that you really want and do the things you care about. And I think, like for me, I've had to take a lot of time out caring for family members, and being able to do that is really important to me. So I've always been very like, okay, I always want to be able to have some means to be able to do that again if I need to, because that's been so important in the past. And just like those things, life stuff, and like making it real and tangible, because then you understand like why you would do it. Because you were saying like, oh, just the goal of like make more money maybe isn't that compelling really in some ways, because you're like, I don't get, and then the loss aversion is going to kick in. So it's like, okay, what does this actually mean for me? And like just understanding how to forecast stuff forward as well. How much cash do you need? What are the different types of assets? How they work? Just like how much money people make as well. Like what is people? I think a lot of people have no idea how much you actually can make if you get your money working for you. So it's covering like all the basics pretty broad, and then getting more specific on.
Yeah, and I always found those things like a calculator that shows you how much if you deposit this much per month. That's great, but it feels so unattainable at the time. You say, right, if I start with £100 a month or £50 a month or whatever it might be, it does build up. But when you look at it and say, right, your pot could be worth X in 30 years' time, you go, well, 30 years' time is a long time. Like it feels so unattainable at the time. Boise, I see your point there. Yeah, historically, house prices have doubled every 10 years. I don't know if they're going to double 10 years from now. If I was trading that, I don't know if I would. What do you think?
Yeah, I don't know. I guess we're in the UK, so land is kind of, and we're not building enough. So I guess it's like supply and demand if you look at it. But doubling it depends on what's going on with interest rates. I don't know. I try not to like make too many. I guess like on average they've been going up maybe like 3% a year, 4%. I'm not sure exactly how much.
Yeah. Although you probably need to care more about what house prices do in Lisbon these days.
Yeah, I live in Lisbon, but the house prices in Lisbon are crazy. It's a really bad, really, really big issue there.
Really?
Yeah, they have like it's very out of line with salaries there as well.
So what is in the percentage of
like how many, say like a average salary ratio to the house pricing there is like really, really mega high. Yeah.
It's well, my favourite place in the world, so I need to come and visit you.
Yes.
B, I'm incredibly jealous that you live there.
Yeah, no, I'm super lucky. I love it. I moved 4 years ago, so
yeah,
yeah,
that's awesome. What when you're what do you think are the most important 3 things that everybody should know when they first take their first steps into the world of investing, or kind of what are the things that the early challenges that you see from people that you work with and talk to? You know, if you were going to say, right, just focus on these 3 things and that will set you right, what would they be?
Yeah, I think there's obviously the practical side of understanding things, but I think some of the misconceptions or like the fears people have are, one, like, can I even manage this myself? And like, I work with like really super smart, like capable people, but it's like, yes, you can. Like, first of all, you can do it. Just going to have to put in a bit of effort to learn about it, and that's the main thing. And obviously, the payoff is going to be amazing if you do that. Like, I think investing time or energy into like learning about this stuff is probably one of the highest return things you can do with your time.
100%.
Another thing is, I think lots of people put it off. So I'm like, you kind of have to call yourself out on that sometimes, because you can always say, oh, I'll do it another time, or I'll do it when I have more money. And I'm always like, yeah, but £1 that you put in today is probably like way more valuable than £1 you put in like 5 years' time. So just do it with the smaller amounts if that's what you're worried about. And then I think there's a big step from going from like 0 to 1, kind of like having that first investment account, like you were saying when you did that first trade. Like that was probably the biggest step, really. And then
it was huge. It was so intimidating, so intimidating. And now, you know, I've been building my pot up over 8 to 10 years. The kind of the daily swing of what your portfolio could be worth, sometimes I just don't want to look at it.
Yeah.
it could be a big number, which again is a nice. It's, you know, it's hopefully over time I've had to realise that, you know, that level of risk is basically the cost of admission, and you cannot have the upside without taking the risk of P&L swings to the downside.
Yeah, I think that's the other thing. It's kind of like know your strategy, know how long you're in it for, like kind of try and have that set out at the start, know what you're going to do and what you're not going to do as well, I think is also really important, because it is really easy as well to get kind of carried away maybe once you get started. And it's like actually like try and have that plan from the start and then just roll with it.
Do you think the industry talks to women well in general?
Probably not. Or I think sometimes as well when they're talking to women, they kind of make it like, I really hate the word empowerment. I don't know why. It's sometimes I work there, like I feel very empowered, but it's kind of sometimes I feel like it's like a softening word. I don't know, like, yeah, I'm going to make you feel empowered. And I don't know, I think it can get a bit girl boss maybe when people like try and speak to women. But I think also a lot of women, women in general have massive motherhood penalties, like wealth penalties. You kind of need all the tricks up your sleeve in terms of like what you're doing with your money. Like you actually need to be smarter because probably chances are you're going to have a wealth gap and like a pension gap and these other things are affecting you. So actually women do need to be kind of like more aggressive with getting their money into stuff and more like on it with it, because chances are you're probably going to be penalised more across your lifetime.
That is a really good point. I mean, also the motivations between men and women can be completely different.
Yeah.
Completely different. You know, you're right. The kind of was a word you used, the kind of motherhood penalty.
Yeah, the motherhood penalty is basically, they've done loads of research around it. I think it's the 5 years after you first have a child, you end up kind of losing out on, I think just like 120k of earnings on average. The ONS just released a study, and I think your earnings are like 40% lower. Because I guess a lot of traditional kind of like heteronormative gender roles, like childcare is really bad in the UK. Women end up taking a step back, and then the issue is the amount you can earn over your lifetime is kind of an asset as well. So that's taking a hit. And then if you're not having your pension contributed to, that's taking a hit. So that is like a big pivot point of where that big wealth gap comes in between the genders. You can kind of trace it back to that. And if people don't know, like, oh, I should be having these conversations maybe with my partner about like, what about my pension? What about this? Because you don't maybe think about it at the time, you're just trying to get by or like figure out who's going to look after the kids. But actually what's happening to your wealth is really detrimental for a lot of women.
I think it's not in kind of, I wanted to say just youth. I just think people aren't talking about it from a savings perspective early enough.
Yeah.
I mean, I know that my first 5 years of paychecks just went straight out the door. I literally didn't save any money at all.
Yeah.
And it's, you sit there and you go, wow, what a waste. And what could that be worth now? Male, female, you know, whatever. It's just, we don't have these conversations early enough, I don't think.
Yeah, and I also think looking at your income and your kind of career or whatever you're doing as a lifetime asset, because kind of in those early years you probably are doing some kind of a trade-off with like, okay, maybe I'm earning less now, but I can like see how that's going to go up in the future, and you're kind of investing in that long-term payoff in a different way as well.
Yeah. So
I always find that really helpful to think about, because I used to work in fashion buying, which is like not a super lucrative career. So that kind of encouraged a bit of a career pivot as well.
Yeah, well, definitely. And did you kind of look at it and say, right, what is going to give me my life goals in terms of the flexibility on where to live, wealth goals on how much money I need? And did you pick the career that way, or was it something you kind of just came to and was good at, and you know you're now building what looked like a brilliant brand around you?
Yeah, I kind of was doing it naturally with my friends, just like teaching them about investments and helping them, and then kind of realised, oh, more people need this. It kind of coincided with wanting to be remote and work for myself. So it all just kind of came together, and I was like, okay. Like very tentatively started talking about it on the internet because it's quite intimidating at the start, and then I was like, okay, people are like responding really well, people really want this, and like there's such an appetite to learn about it.
Yeah. Well, I think that's all we've got time for, so thank you so much, Hannah.
Yeah, thanks for having me.
And it was the category you were in yesterday, the Finfluencer Awards. It was best up and coming?
I was like rising star.
Rising star.
Rising star.
You're a rising
influencer,
star.
which is really funny because I just never would have thought my career title would include Finfluencer. So yeah, here we are.
Nice. Well, thank you very much for coming in. I think you're now going to get the Morning Porridge live show. So stay tuned for that, and I will catch you next week. Thanks for coming in, Hannah.
Thank you.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Right, Billy boy, here we go. Well, welcome back. I'm joined today by Shrek and Gru for a Halloween special. How are you, gentlemen?
Well, I may be Shrek and Scotty might be Gru, but the scariest thing is you just being rich.
Very good, Mr. Blaine. Very good.
Halloween special. Welcome to the morning porridge special this morning.
Now, the morning porridge, we noticed that there is a spook in the morning porridge as
you
well.
joined in. I don't know if you heard us earlier on about how Merlin Entertainments used to cause great merriment on the trading floor because for some reason everyone said it was the most Halloween-y haunted stock. And now I see on the porridge this morning you've got a classic bed sheet with eyes in it, but then interspersed with some technological.
We can probably show that, can't we?
As well. Yeah, actually, yeah. If you go to my.
So, here we go.
Laptop.
This morning's morning porridge, a horror story from 2035, techno-feudalism.
There we go.
Now, to me, Halloween, or Samhain, as we know it in Celtic and Gaelic, is the time when the veils between the worlds are very thin indeed, and you can get things slipping through them. Which is why this morning, the bulk of the morning porridge is something that's come through to me from 2035, when we find ourselves in a very different economy. It's one where effectively techno-feudalism, which one of the big fears of a lot of people, that techno-feudalism describes a situation where you have all these tech lords have managed to establish themselves at the center of the global economy, where effectively they charge rents. So in this morning's morning porridge, I talk about, Lord Lucky from Andrewill, who is charging us money every month for the shoals and flocks of drones that are protecting the UK. Lord Thiel of Planeteer is charging us for the Planeteer Health Service, which used to be the National Health Service. And then, of course, we have the London Reconstruction Fund after Google had a nuclear decapitation strike as part of its hostile takeover of Meta.
Ooh,
I can be very imaginative on a Halloween
Absolutely,
morning.
that's a real Halloween horror story.
I
isn't
like
it?
this.
Anyway, it's a bit of fun in the morning porridge this morning, looking at what the future might look like in 10 years if tech lords continue to make ourselves busier and busier. Now, I was hoping to be up in London and joining you in the studio this morning. Of course, I find myself in my very expensive home studio instead. And the reason I didn't come up was my wife's going in for an operation on her broken knee, and I have to be in the house for the guy to come and repair the dishwasher. Now, this is the 4th week in a row that I've been waiting for the guy to come and repair the dishwasher. And this morning he phoned up to say that the spare part that's arrived is broken. So he's coming back next week. And I tell you, I just about lost it with him. But that kind of sums up the whole economy, doesn't it? You sit there waiting and stuff doesn't arrive. Anyway, what have we learned this week? Rich, Scotty, what are the big things that hit you this week?
Well, I just to touch on that point though, so you're saying in the future we own nothing and we rent everything, which is the way that Blackstone and BlackRock want us to move.
Yeah, of course, absolutely. 3 or 4 oligarchs.
We become mere serfs in a technologically
It's the future of
society.
oligarchy, isn't it?
And are we plugged into the Matrix, or are the robots that we rent for £500 a month running around?
No, you're not allowed to complain about this. If you do, you'll find yourself working in the Greenland rare earth mines on a 10-year sentence. I've come up with the American King Scotty.
You've just made that up, haven't you?
Yeah. I did. I made that up. King Scotty. And even to be slightly disloyal will get you. And what I've done is I've contrasted what happens with this tech-led serfdom that we have in the West with what's going on in China, where the Emperor Xi has created the Chinese co-prosperity sphere that stretches all the way from the shores of Japan right the way to the English Channel. Macron has become life president of Europe, but is effectively a Chinese puppet. And the Chinese have come up with this terrible, terrible scheme, whereas to be successful in this Chinese economy as an entrepreneur, you get judged solely on how much you pay your employees. Now think about that for a second. The more you pay your employees, the higher up you go in the economy and you become part of these things. Now, think about how terrible it would be if employees were paid lots of money and had money to go out and consume things, therefore creating a strong economy. It's a shocking idea, and it would create the collapse of everything. Capitalist, socialism, gosh, whatever next.
God, you
Anyway,
might
just go
even
and
have
read it
no
all this
homeless
morning.
people trying to rob things on the streets as well.
Yeah, well, you probably get extra credit if you take people off the street and save the state money by giving them jobs so they can actually go out and afford to buy their houses and rent their houses or whatever and buy consumer goods.
Like
So
a dishwasher that works.
Like a dishwasher that works. And it's a bloody expensive dishwasher as well, which is particularly annoying. Anyway, enough of that.
Yeah, this
What
week,
was
Scotty.
big event? What were big events of the week?
It was quite a different, this stage of the week to us is quite different to the beginning of the week where we'd had the Trump and G, it's all fantastic, you know, gap high. This is obviously extremely equity focused because I look at bond market prices, but I didn't work hard enough at school, so I would never try and stand shoulder to shoulder with you talking about the bond market. But just in simple equity terms, I know. But
I'm just going to give you a page from the FT. You can pin it to the wall, and you can throw a dart at it and pick what you want to invest in.
Absolutely.
You know, give monkeys enough stock market tickers, and they'll pick it right.
Absolutely
in
right.
Bonds, Scotty,
Absolutely right.
In bonds, there is truth.
That's right. In bonds, there is truth. That's right. Hence, most bond traders I've met always have a heavy dose of pessimism in most conversations. But yeah, I think for
nonsense.
us,
Look at me. I'm the happiest man on the planet, and I know how to spell bond. It's not
the
difficult.
happiest optimistic bear. I think for us, we did highlight. It was quite interesting to me to hear at the beginning of the week, where of course it's all about earnings and mega cap tech and AI spend, and people were just basically brushing off the Fed meeting.
But isn't that right to brush off the Fed meeting? I mean, because I think the two big macro events of the week have been the meeting in Korea. Now, what that told us is that, and it was fascinating to watch Trump's Asia progression, where everyone was greeting him with sycophancy, and I thought it was hilarious that the Koreans actually gave him a crown. Yeah. Now, I think the Koreans must be very funny people, because that was obviously a piss take. I mean, that was brilliant, giving Trump a crown, and he didn't go, yeah, funny. He thought, how kind of you? And the Japanese, it's hilarious. But then you watch Xi and said, I'm not dealing with you. I don't want to talk to you. I'm here because I have to be, and I'm going to be here for as short possible time, and I ain't going to respond to your efforts to buddy up with me. What China sent was a real signal that they are now equal, if not ahead of America, and that's what we need to be thinking about. Which of these two powers is going to get ahead of each other in the critical things? And the critical things, as we know, are things like tech. Now, the Chinese are probably closer to getting over the gain line in a lot of these areas, whether it be from hypersonic missiles right the way down to quantum computing. And we got to keep a key eye on that. We got to see what happens. And then the second thing, Scotty, you just referenced was, everyone shrugged off the Fed meeting. Well, is it that important? What we learned during the era of QE was that if you have ultra low interest rates, stock markets love it. If you make interest rates too low, what happens is people go and borrow loads and loads of money, but they don't invest it in the real economy, because if interest rates are 1%, then returns of 2% from the real economy, it's not that attractive. So you're much better borrowing money and buying financial assets with it. Because if all the other money is chasing financial assets, what are they going to do? They're going to go up. And if you buy back your own stock, it pushes up your stock price. So having interest rates at the sweet spot level, which is probably between 3.5% to 4% in the US economy when inflation is around 2%. So we're practically there. And that's why the market is not that bothered. Yes, if interest rates were cut to 2% or 1%, as Trump seems to want, you'd get a repeat of that massive financial asset inflation. Stock markets would love it, the rich would get richer, and the MAGA heartland would be extremely disappointed that they weren't sharing it and all. So I think we got to stop focusing on interest rates so much. And that's why, Scotty, I'm so interested in what you think is going on in tech just now, because we're definitely seeing a big divergence between what looks to me like Facebook Meta scrabbling to work out what it's spending all this money on, and Google, who I see as the Bond villain in the piece, Sergey Brin, trying to figure out how do I take over the world, which is why I made him one of the anti-heroes of my piece about 2035. Sergey Brin, a guy who nukes London because he thinks that Nick Clegg's still on the board of Facebook.
To expand on that then, Bill, why do you think that it's Alphabet trying to defend their search business? Why do you think that they rise above everybody else to be the Dr. No?
Yeah, because their business is infinitely dependable. They have one of the best money-making businesses on the planet. You just take a look at what has happened to the advertising industry, almost in a parabolic curve over the last 10 years, where now 90% of advertising revenue is flowing through mechanisms like Google. Google wants to hold that, and they've figured out how you do that. I mean, we all know it. You talk about, if all of us were to shout Breville toasty machines loudly now, I guarantee that your feeds will be full.
I want a
toasty machines. I guarantee that all our feeds will be full of offers to sell us toasty machines in the next 5 minutes. And that is a defendable space.
New dishwasher.
Yeah, I seem to have adverts for dishwasher parts on mine, but yeah.
So, and Google has a clear strategy how they're going to do that. They're going to create AI tools that focus on continuing to pull in these revenues. What is it that Facebook's doing? Well, you tell me, gentlemen, what is Facebook's strategy? I mean, a couple of months ago, they were paying 100 million salaries to get folk on board. Now they're just spending for spending's sake. What's their strategy?
So we knew that he wanted to go down the metaverse route, and he was
because that was really successful, wasn't it?
Yeah.
Well, that's the thing, right? So the stock dropped to $100, and he was shamed into reducing its importance, despite the name change. But his plan now, do you think he has something in the back of his mind that he isn't being upfront about, or do you think that it really lacks planning like the market has suggested this week?
Gentlemen, I'm a bond analyst. I'm a bond guy. I focus on the real. I rely on people like yourself to tell me what's going on in the fervid imaginations of people like Mark Zuckerberg. You tell me what he's doing, because I can't see it.
Yeah, and the whole TikTok plan went to pot because, of course, the big security threat. We ended up having Trump's granddaughter sitting with her feet up in the Oval Office this week on TikTok, scrolling videoing herself on TikTok, saying, "Isn't this crazy? I can scroll TikTok in the White House. This is bizarre."
Yeah, I think
that is one of the. This is a little sidebar very quickly, because one of the things that we were expecting, the big agreement that Treasury Secretary Scott Bessent, the adult in the room in Trump's administration, had hammered out in the pre-agreement with the Chinese, was some kind of solution on TikTok. Now, my understanding was that we were going to see some kind of coalition that would be Larry Ellison from Oracle, the Murdochs, and probably some Trump family members come in to own one of the most powerful news manipulation tools on the planet.
Yeah.
I didn't actually see anything regarding TikTok coming out of yesterday's morning's agreement in China. So I think I missed something there, because that is actually significant, because TikTok not only is a money-making machine, but it's an extremely powerful manipulation machine as well. And where that goes is going to be fascinating. And one of the things I'm loving just now is every day you read another story about the Trumps. Yesterday it was one of the Trump offspring has joined a drone company. And this drone company was worth the square root of zero a few months ago. And suddenly it's landed the biggest ever drone contract from the US Army.
Isn't that
and
incredible
I just
foresight?
posed the question, but what about Hunter Biden's laptop?
Yeah, it's almost got to soap opera stage where he hasn't even had a year in office yet, really, is he? So it's
but here's the thing: we don't notice anymore.
No,
it just wafts over us. We don't care. We don't care. And this is again a really interesting stage in what's going on in Washington. The disruption has been so great that the economy is actually getting on fine despite it. The US economy remains resilient. Here's us having serious discussion. Well, on a Friday morning, who can be serious, especially not in the morning porridge, but we've got an economy where we're actually having a serious debate about what business plans from some of the most powerful corporates in the world are. And we've got a US president who just seems totally, but we're not worrying about it because we know the economy is going to remain robust, and that, if we see things happen, they'll probably correct themselves. So there's nothing really to worry about. We're not that concerned about
Bill, you're
inflation.
angering the Trump fans in the chat. Oh, you've got them going now. This is boring. I don't want to hear you anti-Trump drivel, Mr. Blaine.
Oh, fantastic. I love it.
Touched the nerve.
I'm not. See, this is the thing is, I'm not anti-Trump at all. I don't think he's anti-Trump. I think he's recognized some of the key factors that are going on in the world. He's recognized the need to have a strong economy. He's recognized that the world is changing, and he's setting America up for that.
Yeah.
I happen to find him more amusing than worrying when I see the destabilization that's created around him. And as somebody who has spent 40 years analyzing market, I'm looking to what's happening. And I'm actually quite convinced that at the end of the day, we will see something probably much stronger emerge. And I think one of the really interesting things in the last couple of weeks that I've heard Trump come out with was his statement, I think it was middle of last week, when he said J.D. Vance and Marco Rubio would make a great ticket together for 2028. Now, the two guys that are worth watching in Trump's administration are Scott Bessent, Treasury Secretary, and Marco Rubio. The pair of them have put together that China deal. And that China deal is going to de-escalate global trade tensions.
Yeah.
And in there, you've got proper adults in the room who are going to move the US economy forward.
Well,
now,
this is the problem. We look
interesting.
on from the UK, Bill, and it has to be with jealousy. Because exactly like Scotty pointed out this morning, we're bothered about our Chancellor, right, equivalent of our Treasury Secretary, not filling in a form to rent out her house. Who cares? They're doing a deal in China.
You know who cares, Rich? Kemi Badenoch cares, because it's about the only way that she's going to get any press time is by showing how very, very caring she is about it and demanding the resignation. You know what? It's petty. It's petty. Yeah. But I'm not that worried about the US economy if we don't get too many more shocks. There's always going to be hiccups, and I suspect just these off the comment thing about nuclear arms testing was probably a deliberate red flag to US liberals to get angry, and that will give Trump an excuse to be angry himself. So if people want to post comments about my Trump derangement syndrome, doesn't bother me. I mean, I'm just watching what it means for markets. And I'm not that concerned about markets and Trump, because I'm looking at solutions which are, and the big question there will be, does J.D. Vance get it? Or does Marco Rubio get it? Or do the two of them get it together? And what will that do to MAGA? These are all interesting questions for markets to consider.
Yeah, definitely. Oh, don't you worry, Bill. You're getting some defence as well. Mango in particular. Great to see you on the chat, Mango. And the fact that one's brought you out to pop in a comment, that's made my Friday. That has.
Exactly. Yeah.
So,
Excellent.
Bill, what was it in particular about Xi that made you think that he was signalling that China now sees itself as an equal to the US?
You know, I've spent 40 years this year in financial markets, and much of that time I was effectively a salesman. In the early part of my career as an investment banker, I was off doing debt capital markets origination, and then later, after we tried to launch a hedge fund and it hadn't, timing was spectacularly off in the middle of the 2008 financial crisis, we became brokers, broking financial institution paper. And again, that's a salesman's job. And as a salesman, you very quickly pick up on body language and the vibes that are coming off what people say. And all you had to do yesterday was compare and contrast the way that Xi was reacting to Trump with the sycophancy we've seen from other leaders, and then listen to his speech, which was very to the point, direct, and common sense, and then listen to the stream of consciousness where Trump was trying to engage in his normal way, expecting the sycophancy that we've seen from European leaders, from Asian leaders, and the rest. And what we got back from Xi was, we're here to do a deal, do the deal. Now that is not a nation that is turning around and saying, please, please, please deal with me. This nation said, right, we're going to deal together. And at some stage, I expect you to be coming and bowing to me, not the other way around. And the way the global economy is going, that's going to happen. Now, this leads us into a second thing, which is history. What lessons do we learn from history? Well, we know that every 100 to 120 years, we have a shift in who the global economic power is. We call that the K2 wave. That's 2 Kondratiev cycles. Kondratiev cycles are about 60 years each of the rise and fall of economies, and it generally links up. So we had the fall of France, followed by 120 years of Britain, and we've just had 100 odd years of America as the global hegemon. And we've got to a stage now where, because of America opening the door by letting China into the World Trade Organization, and America engaging with China, China is now the most powerful industrial nation in the world. And so China expects to become the new global hegemon. And that's what we're seeing. When the trade war with China broke out, Trump chose to do so. We very quickly learned that, it wasn't America that was holding the aces. America thought that its markets and its access to chips gave it divine world power. Well, no, the thing that drives the world turns out not to be chips, but the things you make chips out of, which are rare earths, and also all the other things that are required, that require rare earths. So it's been interesting to watch how America has woken up to this, running around the world trying to do deals, like in Australia last week, trying to do a rare earths deal. But it is going to take 5 years at least of Manhattan Project effort for the US to develop new supply chains in rare earths, which means that it has no alternative but to deal with China. And that's why I was watching President Xi of China treating Trump not even as an equal, but more like a supplicant at his court. And that's the reaction have to cope with. Now, if we go back to where we started this conversation this morning, it was about how the next evolution of tech, in other words, the next series of tech products that come to the market and create the next big boosts in consumer economies, and where are they going to come from? And it's things like quantum computing. It's not necessarily just AI, because quantum computing is real, and the Chinese get there first, then AI is a sidebar.
Yeah.
And then it's also things in the military like hyper or we'd call them hyperspeed missiles and that kind of thing. And the Chinese have already got leads in these things. And if you want to know what's really happening, just drive up any motorway in the UK and count the number of Chinese cars that are now on the road. And Rich, Angeline, and you and I, we discussed Chinese cars a couple of weeks ago. They are half the price and just as good. Now, I have not bought a Chinese car because I want to wait and see how much better they get.
Yeah.
Yeah.
Just to touch back on rare earths there, I did mean to tell everybody I bought back into Pensana. So Pensana, as you know, when things start to go parabolic, then I do like to take the profit. Always too early. I think I sold out at about 140 in these. But back down to 111 on Wednesday afternoon, I bought back into Pensana. So that is one to watch. Remember, rare earths in Angola, and all this hype around MP materials. You'll see that one will have come back as well over in the States. You see very similar. So rare earths trading similar patterns. But I think that Pensana's found a bit of...
So all these graphs just demonstrate the way that the market's thinking. They think that there's an agreement on rare earths there. They're not looking at what happened yesterday in Korea, maybe in the way that they should be, that it's actually a major strategic shift that just went on. We know it's going to take years for guys like Pensana to be able to deliver the rare earths they promise.
Yeah.
B, you're dealing in a country like the Congo. So there's a lot of risk involved there.
Yeah, Angola, slightly better than the Congo.
Angola.
Yeah.
Apologies. They are very, very different. Not right next door to each other, but very, very different. The risks of delivery, are high. And the chance that they become irrelevant if we see a more substantial solution to rare earth supply occurring. Let's imagine a very positive world where all the trade issues de-escalate and somehow China, America, Europe, the rest of the world all agree, let's have a real push for all kinds of solutions on climate change and global tech and all these things.
2015, suddenly, you mean?
Sorry?
2015.
Yes. Yeah, let's go back 10 years where everyone was playing nicely in the schoolyard and we all expected a better world rather than the one we got. Let's assume that it happens, and suddenly the pressure to develop all these emergency alternative sources of supply just become a thing. So if you are playing in these stocks, you've got to do it the way you've just done it, which is not to be scared of missing the last 10% of a rally, but be more afraid of catching the first 50% of a collapse.
Yeah,
Absolutely.
Yeah, 100%.
Bill, so it's Scotty's last day today. He's off to new ventures.
Yes, I said on the show this morning, but I've been practicing my sales pitch. Would you like fries with that? So that starts on Monday.
Yeah.
So,
What do you say to an EastEnder in a uniform, big back and fries?
that's right, absolutely. Absolutely.
I've heard that
That's
before.
a terrible joke. I immediately pull that before I'm cancelled by the whole Essex.
No. As an EastEnder, that's perfectly acceptable and spot on.
Once you find out where he's going, Bill, which we haven't disclosed, then
Where
you'll be more careful. Trust me.
As industry traditions maintain, I couldn't possibly say, but I'm sure you'll find out next week.
Yeah.
Oh, please do. Please let us know. I mean, here's me jumping on board a late career in financial markets and journalism, whereas I've been happy to be an investment banker for decades. I never knew what fun it was to be able to come on board a TV show like this, Rich, and actually say what I think.
Well, there you
and
go.
It must be working if I've upset the Trump tards.
Absolutely. This is what it's all about. It's all about getting reactions.
Excellent. Good.
We won't tell you where he's going, but he's moving from 2 initials to 3 initials, and it's not MI5. So we'll leave it at that.
Okay,
Bill,
we'll
it's been wonderful as always.
Okay.
We're going to see you. I am seeing you in 12 days, sir.
Indeed, yes. Now, what is it we're going to be talking about? Remind me. It's something like being the difficulties of being a bear in an exuberant market.
Will it still be an exuberant market by then?
Well, I've got to come clean. We've been doing these slots for what is about 2 months now. And every time I say, oh, October, it's the harshest month for markets. It's always October when it goes badly, badly wrong. Well, here we are, Halloween, the 31st of October, stock markets still pretty much hitting a new record high every 15 seconds. And I am resolutely wrong, as I have been for the last 20 years, about the imminent collapse of global stock markets. But I'd like all the viewers to think about me as that little bit of common sense sitting on your shoulders, whispering in your ears that never believe that this time it's different, which is why this morning I introduce a new book. Which way does that go?
There we go.
Right, this is Sorkin, and you'll notice that there's a sticker on it which said, can I get that in focus?
There's in front of your page.
Yeah, unfortunately, you've got to hold it in front of your face, Bill, which is...
Signed copy of Alan Sorkin's new book.
How did you get it signed?
Well, because you got to be in to be in.
Oh, that's impressive.
Yes.
I must admit, I'm not a big fan. He's a little bit too far to the left for me, but his TV show Billions,
What do you mean you're not far? You're a Scotsman. You're genetically built to be far to the left. That's ridiculous. The thing about Sorkin is he's a great writer. It's very, very readable. Now, my advice to everyone watching is you need to know what happened in 1929. And the book everyone must read by the age of 21 is J.K. Galbraith's The Crash of 29.
Right.
If you haven't read it, you should not be playing in the sandpit that is global markets. So make sure you read it. And I would recommend reading this one as well, because it gives another perspective and it tells it from a picture that you will recognize as being very, very similar today. Now, history never repeats, it never can, because every time we have anything happen in history, it changes the world, so you can't repeat. But history does resonate, and it's well worth, here we go. £7, that is worth a degree, a master's in trading, just reading The Great Crash in 1929, well worth a read. And the new Sorkin book, 1929, I would add that to the list.
Fantastic.
That's brilliant.
Good stuff, Bill. Have a wonderful weekend, and we'll see you next week.
We will be back next week. And Scotty, you and I must have a sidebar chat very, very soon.
Yeah, absolutely. Look forward to it.
Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello.
Back again, look.
Come on, then.
I'm not the host, you're the host.
No, you decided you'd sit in my seat, so you go for your life, sir.
I prefer this seat because we've got new chairs, but I'm still not sure about the chairs personally. We're still deciding.
Lovely black, the finest black velour.
Yes.
So be careful not to wriggle around too much. You could start a fire.
Yeah, I'm really they're a bit wobbly. But hello,
Right,
everyone.
Bill, what are we here for?
Well, I wanted to come on and personally thank Scotty because as much as like we've obviously had everyone kind of saying thank you as well.
Yeah.
Obviously, to kind of taken over, it's been stressful working with Rich every single day. So you've made it much easier.
Thank you.
And even the kind of little bits here and there, we're always willing to kind of come on. It's been really, really helpful. And also, everyone's really enjoyed it. It's been fantastic. So I found it quite inspiring as well to listen to you and learn from your teachings. So what we've organised, and get my chart up, Terence, please, is we've got a little goodbye card, which I'm not going to send you yet because people are still signing.
Very good
but it's sent to the Discord. If you do want to sign it, it's in the private chat that I made last night that hopefully no one could see. But I will just kind of put it to everyone because it's Discord has a limitation of channels. You only put 100 people on the channel. And now Discord's more than 100 people, so I had to aggressively knock people off that I didn't know who they were. And I was like, I'm sorry, you're just not.
Got you.
So
I did spot Maturin's actually just put in the chat the way to join the Discord. So if any of you are watching and you think, what is this Discord chat about? Well, Maturin is the boss. He's the security guard at the gate, and you can see in the chat how to join up.
Yeah, exactly. So if you want to say goodbye to Scotty, and if you want to send any messages before he joins the Big Archers, then please do get your kind of kind words in. And what we've also pitched into as well is a gift card for you to enjoy lovely dinner and drinks at the Devonshire.
That's incredible.
Put 100 quid behind the bar there.
So
that's very generous of you.
Whatever you want.
Thank you very much.
You're more than welcome to invite us, and we'll just spend the money anyway.
Yeah, absolutely. Yeah.
But,
exactly. I'll let you know if you wait for me to message you. If I don't message, just keep waiting.
Exactly. It's a stand up.
Yeah.
So this is just a thank you.
That's incredibly generous.
You're welcome back anytime.
That's very nice of you. And for my part, I know that we've had these discussions on in the last few weeks. I'm leaving, but it's been one of the best things I've done. Right. I do wish everybody on the show every success, as I'm sure it will grow and grow. And for everyone on the Discord, we will keep in touch. We're going to have to figure out, I'm going to have to take a bit of a hiatus or have some sort of pseudonym or whatever. I can't believe what it could possibly be. Guru, perhaps. But no, no. Obviously, there's a couple of things that I have to just establish in my new home. But yeah, it's been brilliant. It's been absolutely brilliant. And it's really reinforced what Rich and I were talking about actually in the studio when we were listening to the segment earlier on about your personal finance and so on with Luke, and we were just saying about hopefully you'll get the ability to expand what you're doing and to continue, and the backing for you to continue and to help educate people, because at the end of the day, I know that we sort of laugh and joke about it's good to trigger people about Trump in the comments. it is an educational platform.
Yeah.
And this is one of the greatest experiences you can have in the markets, but it can also be one of the worst. And to try to guide people through that has been, for the few months I've been on, it's been a great honour. We've had some great feedback from people, which has been extremely flattering, because you don't get a lot of direct feedback if you're working in a sort of regular job. But yeah, on here you get live and direct feedback, and it's been brilliant.
Fantastic.
Danny gave you a lot of feedback all the time.
Generally about shouting from his office, where's Rich gone? Yeah, where's Rich gone now? Why have the Russians done that? Why have the Turks done this?
Where do pregnant women even go?
Where do pregnant women even go? Yeah, exactly. Yeah, and so on and so forth. So yeah, it's been fantastic.
Great.
It really has. I can't thank you all enough. And again, thanks for the messages, everybody. Last week, this week, it's incredibly flattering. And yeah, thank you for the gift as well.
Oh, my pleasure. And the thing is, like, a lot of the stuff that you've kind of brought kindly as well in terms of the educational stuff, the content, we want to start kind of curating that a bit more into actually a proper, like, kind of produced segment. So we're going to kind of take a bit of inspiration. So you'll always have a lasting effect on Trade Live with IG.
Thank you.
So yeah, I mean, just wanted to come on and
I really appreciate it.
Yeah,
thank you very much.
So
Good stuff. We see everybody coming through in the chat as well. Top man Scotty, top guy Pelicans giving you a wave there as well. And yeah, very much good luck, as Rock says. So that is it. I'm saying goodbye to Scotty for the third time, I think.
I know, crikey.
In
will there be a
the
fourth?
world.
Well,
only time will tell.
stay tuned. Keep liking and subscribing.
Now that is the valid only time will
That's
tell.
fair enough. I'll take that.
Yeah, exactly.
Everybody have a wonderful Halloween. Don't get spooked by the markets as they head lower this afternoon. But yeah, very.
Not Amazon though.
Yeah, not Amazon. I don't want that one.
Yeah, exactly.
$2.55. If it's $2.55, I'll take you to Devonshire for a long
go.
You'll have the good vouchers value.
Yeah, exactly. Yeah,
I'll be watching and tweeting, going, "Oh, I've heard Amazon are gonna, let's just get the shares up, get them up there."
Have a good week, everybody. So we'll be back next week. Producer Phil, what have we got on the show next week?
A little bit of a spoiler. Yeah, we'll do a bit of spoilers. Angeline's back. Thank God for that. This week's been awful. No, it's been good without Angeline, but we have missed her. So a couple of spoilers for next week without too spoiling it. Garth McKenzie on Monday to give us his weekly outlook. We've got Garth has kind of potentially signed up for like a Monday segment, bi-weekly Monday segment. So he's going to give his outlook on how he thinks the markets are going to happen next week. Julian Wheeler Tuesday, John Mayer Tuesday, Piers Buckworth Wednesday. Maybe we'll see if he turns up this time. Andrew Webley is coming back from the Smarter Web Company on Wednesday. Simon Popple on
top
Friday.
Questions for Mr. Webley.
Yeah, this will be a fun interview to watch. Simon Popple talking about gold on Friday, and then Morning Porridge live again on Friday. I've done my job for the week. I've already booked it all in.
What a menu.
Yeah,
what a menu.
Beautiful.
The Turin's leaving us with. So, Rich, you're the common denominator in when Scotty leaves. Thankfully, it was me leaving.
Yeah, that's right. Exactly. Exactly. I should be clear. It's a score draw as regards who left.
Yeah. Brilliant. Right.
Cheers, guys.
And yeah, thanks to Mars as well, who gave us the idea of the Devonshire.
Oh, did she?
That
was very nice of her. Well, thank you, everybody. Yeah,
he was asking me, what should we get him? And I was like, why are you asking me? You've known him for 20 years.
Yeah, exactly.
Buy those.
All right. Goodbye, everyone. Have a nice weekend.
Cheers, guys. Take care.
Peace.
Shut up.
We are back. This is Overtime. I'm Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan. Our returning champion, Thomas Westwater, in Chicago. Gentlemen, it's kind of a soggy day out here where it's tough to point the finger at anything other than the Fed. Your thoughts?
Yeah, I agree with that. I mean, I think that there are certain pillars here. One is rate cuts and a relatively dovish Federal Reserve, along with obviously the supernova. And I would say that, those aren't the only two pillars, obviously the labor market and sort of the tolerance for tariffs and all this. But I think that two of the major pillars got, kicked around yesterday. More significantly, the rate cut pillar, other than there was obviously the noise on the Microsoft and the Meta earnings yesterday, but that seems to be less consequential ultimately, at least for the moment. But I do think that it's sort of a digestion of the realization that more rate cuts in the short term are not a foregone conclusion.
Yeah, I mean, I think that's exactly right. I think the term I used in the article I wrote in the postmortem of this FOMC announcement was, if not a piercing, then a denting of the armor of indifference that the markets had, where essentially they came into this week thinking, listen, we're living in the best of all possible worlds. Everything is great. Everybody's Dr. Pangloss, and everything's fine. Because the Fed is going to do what the Fed is going to do. It's all priced in, la-di-da. And the Trump talks with Xi are going to be great because they already pre-announced everything, and clearly both sides want to climb down, so at least the intent is there. And of course, Trump came out of the meeting glowing, and nothing ostensibly specific has happened other than everybody's decided that shooting each other in the face was not the move for anyone, and so everybody kind of backed off. The earnings thing, everybody went into going, oh, great, tech has been beating average earnings growth of 22% versus the average for the market as a whole at 9%. This is not going to go badly. So markets came into this week basically going, everything's fine. There's nothing to think about. There's nothing to talk about. All the risks are already off the table, which of course, and we talked about this on the show, made the markets basically priced for perfection. That is, if everything went right, there wasn't really much to do. And if something went wrong, everybody was skewed the wrong way. And so that's sort of how this Fed thing felt, where it wasn't really even that Powell said something so dramatic or out of sorts. He certainly made a point of saying December is not a foregone conclusion, but the markets really were kind of built around a pillar, amongst other things, that it was. And so that, looking at the price action here, that seems to have clearly done something untoward for the S&P. Because if we look now at what we've got on the chart here, we can see, I think, very clearly where the Fed is. I mean, there's that quiet sort of sideways thing. Then the Fed itself, the announcement passes without really very much notice. Then Powell starts speaking, you get the big sell-off. You rebound into those earnings that we got yesterday. That makes sense. Notably, those same rebounds don't appear if you look at, let's say, the dollar. If you look at bonds stay on the lows, the dollar stays up. You don't really see that kind of reversion. So it's tempting to say that really the market just didn't want to make up its mind ahead of things like Meta and Google and Microsoft. But now we see what's happened since, and everything's basically leaked lower. An interesting sort of tidbit here that I wanted to get your thoughts on was the implications for gold, because I think that's sort of part of this equation. And for some reason, our gold charts are having some trouble coming up here. Let's see. Oh, here we go. So, gold. You'd think yields are up, dollar is up. Why is gold up? How does this fit into your narrative.
I guess I would say, is gold really up? I would take issue with your assertion of up. I mean, in other words,
that I think that's fair.
I mean, and to the degree to which it's up, it's a fractional upness off of a huge sell-off material. I don't think it's anything.
Yeah, I mean, I think that's fair. I mean, gold has obviously been in consolidation mode here, and if we look at where the Fed was in this whole calculus, I mean, here's the Fed right here. This is Powell speaking. Gold was already on the way down. Powell gave it a kick. It kept going, found whatever bottom of the range exists down here, and then recovered to basically unchanged relative to the top of the range from whence it was descending yesterday. I do think it's curious that even intraday, sort of over the course of this right here, gold still manages to recover, whereas, I mean, obviously, we don't have to go far. Here's the dollar, and there's Powell's speech. I mean, there it is.
I mean, I think that is the variable. I mean, I think the question is, you know, I mean, because Mike Butler was talking about it yesterday, sort of what is the mathematical component of this for the degree to which the cost of capital, the projected cost of capital, or the projected risk-free rate, or however you want to sort of say it, has been adjusted higher for the next 3 months. And I think that is the sort of meaningful adjustment that's across the board here. By the way, also won't surprise me if within a day or two the market goes full supernova again and doesn't care. So I feel like that this is a day of digestion on the back of a real piece of mathematical information having to do with the cost of capital in the short to intermediate term. But we've also seen the market absorb this kind of information more than once and then decide, the hell with it, I'm going higher anyway. Same thing happened with tariffs, which basically incremental increase in the cost of products.
Thomas, you wrote the preview, so I go to you with this question. We've obviously seen the markets kind of fall out of bed here after this Fed thing. So with that in mind, what are we talking about as far as these incoming earnings? Is that going to be the saving grace here? We've got Apple, we've got Amazon. You wrote the Apple piece. You're surely deep into the Amazon piece. Enlighten us.
Yeah, I mean, Apple, it's all about how iPhone 17 sales did. And it's looking like it's good. There's a couple of research firms that track early numbers, right? It was only about 9 to 10 days in the reporting quarter that iPhone 17 came out. But if those early numbers look really good, that could help really propel the stock higher. I mean, it looks like, you know, this cycle, people are actually going to upgrade their phones more than the last cycle. So I think there's going to be some bullishness in the numbers. Of course, it's had a good run, you know, so if it's bad, it might, you know, take a little dive here. I would see that as a buying opportunity for Apple long term. A lot of people's, you know, they're saying, why isn't Apple investing in AI so much? And I mean, I don't really think that's true. They're not investing in large language models. You know, when you think of AI,
that's an excellent distinction.
But they are investing in it in terms of integrating it into their things like a true AI series is supposed to come out. They're integrating it across their products line, just like Meta has done across Instagram, WhatsApp, things like that. Meta's done a very good job, but the earnings report wasn't that good. I see Meta as a buying opportunity down here. So, you know, the numbers, I think they come out usually 30 minutes after the bell every time. So we're about 12 minutes away from Apple. Amazon, I haven't looked into the numbers yet, but obviously the market likes the reaction there. So, you know, I think if you get a positive Apple report, that's just such a big weight on the market that it'll help drag us up. See it as a buying opportunity. I mean, it would be great in NASDAQ futures if you got down to the 50-day SMA where, we've had some solid support on those pullbacks. But, I think if we get down to the 9-day EMA, that's a good buy point right there. Got a little bit overextended here, this week up until today. But I still think it's all about earnings. As you said before, trade tensions are continuing to cool down. So, that's more relief off of the macro narrative, growth cooling and everything like that. So I'm pretty bullish here. I think, it's a 1-day pullback. I don't think it's time to ring the alarm bells yet. I see this rally still going for quite a while.
I mean, to your point, the rally that's certainly getting a nice little pick me up here is on display here with Amazon. Earnings beat expectations. EPS of $1.95 versus $1.57 expected. Revenue of $180.17 billion versus 177.8, it looks like, billion. EPS up 36% year on year, revenue up 13%. Solid numbers, clearly, and the markets like it. So it's looking like at least this part of it has gone pretty well.
Yeah, and if it was a case of where the market is panicking, it wouldn't matter if the Amazon numbers were good. It would still be selling off with everything else. The fact that it reported good numbers and the broader market's down, it's especially bullish for Amazon, but I think it speaks to that we can recover here. And I mean, one day, I hate saying, one day we pull back and, calling for a broader unraveling of this trend that we've had. I think you need a lot more downside to where you could call a market top. So, I mean, I'm not saying anyone is saying that here, but
sure.
I think you would need a lot more. I think, these pullbacks that we've had, they've been buying opportunities almost every time. You could do it after 1 or 2 day sell-off. A week or two later, you're in the green again.
So far, that has certainly been the order of the day, at least since the lows in April. Just a little tidbit here on Amazon. It looks like operating margins got weaker on the actual goods selling and shipping side, both for North America and internationally. But Amazon Web Services, that is the cloud, that improved and improved by almost 2% quarter on quarter. So it looks like that's what carried us to these positive results. I think we're still waiting for Apple to hit the tape here. Hasn't appeared yet, so we'll see what goes down here. But to your point, clearly a lot of this stuff has been bought very quickly on every downswing. I do wonder, as I'm sure nobody is surprised, I do wonder whether what we're seeing here is kind of larger and more worrying, not necessarily because everything hasn't been bought, but because you've gotten to a point, and you were always going to invariably get to a point, which maybe we haven't gotten to, and maybe we have, where that stops. And to try to tease out where that point is, I think going back to this idea that at the beginning of the week, you were coming into a place where you were sitting at record highs, and all the good things that the markets were looking at were known and onboarded. And it seemed like there was relatively little room to get any better news. And when you're priced for perfection that way, just in terms of speculative mechanics, you're kind of tilted. And so what good news comes out leaves you anchored. And if any of the news is less good than perfect, then you're vulnerable. But to your point, that need not last longer than the event risk itself. And so, okay, we've had the Fed. The markets didn't like it for a day. Will they not like it for longer than a day? And I think that's the Apple test should be an interesting test, because of these two, one would think Apple, to what you were saying before, is probably the one that's the more obviously positive, because we had those early reports that iPhone 17 sales are going well. And Apple has ostensibly already rallied on this. So this would be confirmation. In fact, we saw a big jump in Apple around it, I think, last week.
And you know, the price action this month, it looks similar to what happened at the end of July into August.
Mm-hmm.
I mean, it looks really similar to there.
Yeah. Yeah, I mean, if you look at NASDAQ here, let's look at the continuous contracts so that we can see more of it. So here's July into August right here. So you get this kind of sideways consolidation and then the next leg. So perhaps this, I think, if I'm understanding you correctly, would be that same kind of sideways consolidation. And this is the extension.
Yeah.
Whereby you probably still have, maybe that much more if you were to sort of assume near perfect symmetrical kind of outcomes here. I mean, obviously that we're just kind of guesstimating for the benchmarking exercise. But if that's sort of your magnitude of move right here, something like this, then if you were to extrapolate it out here, then one would say, okay, if you had the equivalent breakout here as you did here, let's be conservative, off the lows of the pullback, maybe you've already done it, maybe you have a little bit more. That kind of a thing.
Yeah, I think there's more room to pull back, but if Apple is positive, I just see, some enthusiasm coming in tomorrow morning.
Mm-hmm. Yeah. I think that's probably the most fascinating thing for me here. And Dylan, I'm curious what you think about this as a kind of market psychology exercise. It makes sense that stocks didn't want to run away selling after the Fed yesterday, when you had big tech earnings after the bell, and everybody went, well, why am I going to commit? Watch, all three of these are going to blow it out of the water, and then I'm going to be screwed. Stock short until the next day. Why in God's name would I go and do that? I'm not going to commit. Let's reset this thing back to around where the Fed was. We'll see these earnings, then we'll go. Whichever way. Today, I mean, obviously, 2 out of 3 of those earnings were good. Microsoft sold off. I still can't quite make heads or tails on why. We were trying to figure out what that was yesterday, because their numbers were not bad by any stretch of the imagination, but they did sell off. Not as bad as Meta, obviously. But of the 3, 2 out of 3 did great, and Google even rallied on its results. And yet the markets can't use this as fodder today. They're not neutral, they're down. Like, I would have thought, frankly, that we wouldn't get this sell-off today. Because I would have thought, you know what, they're going to wait. They got Amazon, they got Apple, why would they make up their mind tomorrow when they didn't make up their mind today? But they did for some strange reason. What do you think that is?
I mean, this goes to the two things you have to think about when you're trading. You have to have the direction right, or somewhat right, if you're using options, and you also have to have the timing right. You know, your timing could be off a little bit, but that's why when we structure trades, you know, we set it a certain time out, 30, 45, 60 days, let it work in your favor. If you're wrong on the timing by a few days or even a week or two, that's okay. And the direction, I mean, you could also use option strategies to give yourself some cushion on direction if you're wrong, and let the time play out and help you that way. So I mean, I see it as we really have to get these results and wait for it to be digested into tomorrow. And I think tomorrow's price action is going to tell us a lot. I mean, NQ, I mean, if we got down to the 50-day SMA, that's a point that's been bought up pretty regularly. So, I mean, I would definitely take a stab at it there.
Dylan?
So repeat the question for me. Sorry.
To me, it was probable that the markets didn't want to make up their mind this way or that, Fed this, Trump and Xi that, until tech earnings are out of the way. Mm-hmm. They showed that kind of resilience into the close yesterday. Stocks bounced, everything else didn't. Bonds didn't bounce, dollar didn't back off. All of the things that were Fed adjacent things, they all held except stocks, and it made sense. Okay, you got big tech earnings after the close. Why make up your mind now? Mm-hmm. But they made up their mind today for some strange reason.
You're saying
before Amazon, before Apple,
Microsoft, and before Apple, and
yeah,
and
yeah, they for some reason still sold off. So for me, I'm sort of looking at this market psychology wise and going, well, what does that mean? Does that mean anything?
I mean, to me, it does not mean much, honestly. I mean, if anything, it means it's a chance to buy, you know, Microsoft or Meta cheaper than it was a few days ago. I just don't. I hold on to the opinion that the dominant factor in the financial markets, well, the most dominant factor in the financial markets is the whim and impulse of the President of the United States. So setting that aside, assuming that the president doesn't decide to unilaterally change, you know, global trade relations in a given evening or whatever it is, then the second most dominant factor is the optimism or even euphoria around the AI the tech revolution that is AI. Mm-hmm. And so, and then the third most significant consideration would be rates and inflation.
Ooh. And to your point, whoa.
But my point is, I think that the
Apple
AI
is out, and it's not happy thoughts here. But please continue.
My point is, I believe that the dominant force ultimately is going to be tech, mm-hmm. more than the Fed. The tech mm-hmm. is only secondary right now to Trump. But what's the situation with Apple here?
Well, so Apple got whacked here. That seems pretty clear. We'll see if it sticks. Results wise, this is interesting because actually these are good results. And this sort of comes back to what we were just talking about. EPS, $1.85 versus $1.77 expected. Revenue almost there, beat by a little. Actual 102.5 billion versus 102.25 expected. So beat by about $250 million. And that's sort of this buy the rumor, sell the fact thing that I was kind of talking about, Thomas, just a second ago. This idea that we kind of thought that these were going to be good numbers when those independent reporting figures came out on iPhone 17 sales, and Apple had a pretty nice jump of them last week. In fact, I think there was a day last week where all of basically NASDAQ's gains was Apple around those reports. Obviously, this is not the world's biggest sell-off. I mean, it spiked down, but now it's kind of clawing at the bottom of its intraday range. It's certainly off the lows. But this sort of echoes what happened with Microsoft for me, where Microsoft's numbers were not bad numbers. They were good numbers, and it got smoked. Not like Meta. Meta's numbers were actually a massive miss. But they did fall, and they didn't come back all day. So is this that? And again, are we seeing some sort of fragility here in kind of larger narrative flexibility?
I mean, I think the obvious answer is yes. I mean, I think that if the reason the big tech names are selling off is because they didn't beat by enough.
Yeah.
Which is kind of what we're saying here, Meta, setting Meta aside. But that the whole thing is, oh, you didn't beat by enough. I mean, that really is getting at the ultimate dynamic here, which is that the price levels on these things are really, really high.
Mm-hmm.
And anything that is not exceptional, meaning an exceptional beat, is going to be punished. And we're getting that. I mean, it goes to also, I think about the sell-off when Trump tweeted about whatever he tweeted about a few weeks ago, and the whole thing went cuckoo bananas for a minute.
Yeah. The 100% tariff on China because how dare they install a rare earths licensing, Raj?
Exactly. What that really sort of said to me was this market is capable of really big sell-offs real fast.
Yeah.
Which is like, that there's a lot of air underneath all of this, right? That was
this right here.
That's an indication of how much sort of free, sort of how limited the integrity of the overall situation actually is. And I would say that the performance of Apple or the performance of Microsoft yesterday are further confirmation of the fact that basically the tolerance for anything that's not exceptional is down to zero.
Yeah. I think
because of the price levels.
Because of the price level. I think that sort of jives with the idea that, and we were talking about this just a second ago, this idea that if you're not going to get cheap Fed money, it's a tougher sell to bet on kind of thoughtless continuity just on sheer momentum alone, because the money costs more. So if you bet wrong and you get wiped out, even on one of these things that are quickly bought up, but you're on the wrong end of one of these periodic washouts, it becomes more expensive to get more money and roll again. And so people are going to be more cautious about being on the wrong end of one of these things.
Mm-hmm.
If the Fed is going to give everybody cheap money forever in large quantity, then we're in a very different kind of a thing. Then, okay, yeah, buy every dip. Okay. Like if you get roiled on one of them, okay, well, so be it. That's okay.
Mm-hmm.
Just borrow for less again and go. But if all of a sudden you can't borrow for less, capital is not as cheap as you thought, well, then there's going to be some constraint on risk taking, maybe.
Mm-hmm.
And maybe the dips don't get bought up as readily.
No, I think all that's true. I mean, I think that the sort of more brazen question is, are you actually willing to incrementally build more, or at least sell call spreads?
I am.
Like, You know,
I'm
even if
not
you're-
selling call spreads. I'm buying put spreads. But yes. Yes. And by the way, the reason I'm doing it is the same reason as what we talked about the other day about buying call spreads if you were of the mind that Thomas is, which is, listen, why are we fighting a market? But it's a very reasonable argument. Why are we fighting a market that's going up? This market has shrugged off more. Why wouldn't you wait, not be greedy, not try to pick the top, let the thing actually take a real concerted hit whenever that's going to occur? Maybe it's this week, maybe it's a year from now, maybe it's 2 years from now, who knows? But let it actually take a real gut punch, let it keel over, and sell into that weakness with the benefit of momentum on your side. In the meantime, if you're feeling iffy about buying at record highs, do it with call verticals because vol is low. You can structure 2-to-1 risk reward positions. And if a face ripper does descend upon you, this is why you have a vertical. You are you're very risk defined. So your max loss is what you set it to be at the onset. And if you roll the dice 5 times right, 2 times right even. If you roll the dice 2 times right and the third one is a face off level situation, well then okay, you've broken even. If you roll the dice 3 times correctly and it's a face off situation, you've actually made money and now you just flip that bet over and go the other way, but this time with the benefit of momentum. So for me, where that gets into trouble is if you're selling vol. Because if vol expands on you in one of these face ripper situations, you're going to have a whole other kind of an issue on hand. And so And it may be that there is an asymmetric vol expansion to the two sides of even a short call vertical. So maybe you end up being upside down in the wrong way. Or for that matter, a short put vertical if you're bullish biased. That might be asymmetric between the two options that you own in the spread. And market might be doing what you thought, but your protection isn't any good. So buying and locking in either on the long or the short side, whatever your opinion, seems to make more sense to me here than selling vol, especially with vol relatively low.
I mean, Apple's up now.
Yes. Let's take a look here.
So yeah, that's what I'm doing. I'm just buying a call spread in NQ. I'm just doing short term, 5 days out, right near the money. Pretty much max loss and max profit are right near each other. POP 50%. I'm gonna take the shot on it.
Yeah. I mean, that's one way to go about it. The alternative would be, instead of saying, okay, if I'm really, really antsy about buying at record highs, and this, your approach, Thomas, is like, you know what? I'm not that antsy. We're just gonna roll this thing, and it works until it doesn't. And the benefit is, of course, you get to keep your losses very small and very risk defined. And worst case scenario, your options expire worthless and you rethink. If you were really, really antsy and you wanted to dilute your exposure to delta in general, to sort of directional delta, you could go far out and not expect to hold it, but expect for that to kind of dilute your exposure to underlying delta. Just have tons of theta in there. So that if you do get a face ripper, you're more insulated than sort of the underlying asset. And then you can just choose to get out.
Yeah, and I mean, we're also going into a week of another week where we have some notable names. I mean, we have a good amount of chip stocks next week. AMD's reporting, Qualcomm, some other names that are AI, ARM Holdings. You know, so we still got more to come, and you know, AMD is looking like it's going to. AMD's been really, you know, up over 100% year to date. It's been on a rip. Their gap to Nvidia is closing with what they're doing. Their benchmarks on every chip they put out gets closer and closer to Nvidia. Some are even now exceeding it, and they're at a lower price point than Nvidia. So they're carving out their own niche in the data center sector, where, you know, they have this client base that's expanding, where you could say, look, we're going to get the same performance or maybe marginally below it, but we're paying, you know, 30% less. So, I mean, they've carved out a really nice segment of the market for themselves.
Yeah. I mean, for me, the logic there is very compelling. What I am concerned about here more so than those kinds of arguments, because I think they make a lot of sense, is sentiment extremes, whereby appeals to logic don't make a dent, only whereas appeals to logic haven't made a dent in sort of guiding us lower, and the market has been resilient. There comes a point after a long, let's call it, dispensation of thinking on the upside, whereby things have become skewed from a sentiment perspective and from an exposure perspective, and thinking stops working in arresting the downside, where basically things just need to even out. And that's where you get those kind of correlation one sell-offs, where sectors don't matter, company specifics don't matter, sometimes asset classes don't matter. Things just go to cash. And everybody just goes, okay, whoa, that was crazy. And so for me, it's as crazy of a bullish sentiment extreme as we've been experiencing, that kind of leads me closer to thinking that to follow will be a bearish sentiment extreme. But there's obviously no knowing when that is. And so you kind of look at the sort of denting of the armor that was the Fed, and you go, okay, how bad was that? And so just looking at the S&P here as a kind of catch-all, here is what, and again, I don't know that this is quote unquote the big one. Who could tell? But I think looking at the sort of overall price action here we were before the Fed. Here's the Fed. We come back ahead of those earnings. We can't stick it, even though most of the earnings came out, I would say, relatively solid. Yes, Meta missed. Okay. But that's sort of the kind of one-off that happens. But here, what you've got now is this sort of general positive earnings, but you still capitulate. Okay. And you're kind of stair-stepping down. You get this new plateau around, let's call it 6,900-ish in the S&P. You crack it. Now we've got the next set of earnings. Obviously, we're bouncing. Still kind of stair-stepping in this rollover, though, and coming in on this former range bottom, but not even moving to challenge it. We'll see if we do, number one, and we'll see if it holds, number two. But it does look like things are sort of leaking lower outside of event risk. And so, and this could be nothing. We saw this obviously across a lot of things in early October when Trump said his scary thing and everybody freaked out. And there was a bunch of stuff that all of a sudden decoupled. We were on this very show saying, why are they freaking out now? He has said things like this 1,000 times in the preceding 6 months. What's this about suddenly? And so it's almost like we're starting to get this kind of extra fragility, as we were saying, and extra reactivity. And for now, obviously, the market is fighting back or has been fighting back. But we didn't even have that before. And so you wonder if kind of the market is getting worn down, if sentiment is getting worn down. And if whatever break occurs isn't going to occur because of this catalyst or that catalyst or the veracity of the supernova or blah, blah, blah. If instead you're just going to run out of hopium eventually because all the good news is there. And there's just no more new good news. And eventually the market kind of arrives at that idea. I wonder also if that's what gold's about. And the reason I wonder, and again, Dylan, to your point, I don't think this is anything like a, oh my God, direction change recovery, but it is curious that gold is up here today with yields up and the dollar up. And I wonder if that's sort of disappointment-ish with the Trump-Xi meeting. Not because it didn't produce anything. It produced exactly what it was supposed to produce. A short-term, shallow backing off from the extreme. I don't think we still know all of the exact details as such, but I saw videos of Trump basically opining on the plane. We got a good deal. We got to renew it every year. Go, okay, so in the structural sense, we have a Band-Aid on a broken arm, and we got to redress the arm. And if anything happens or the president changes his mind, as he often does, then what have we actually achieved? So I wonder if gold being up here is, if we sort of think of gold as we have before, as a kind of multipolarity idea, as the idea that gold is the thing that's going to be the go-between. If the US and China were to go into separate kind of payment silos, where China is like, you're not going to use your economic weapons on us. We're just going to go into a different payment silo and just be by ourselves. And we've shown we can do that by scaling Russia. But so as you're not freaked out, gold will be a backstop to the settlement here because the yuan is not convertible internationally still. So we'll backstop you with gold, and gold will be your go-between so that third countries like, let's say, a Brazil or a Turkey can both do business with the U.S. and China, even if the U.S. and China are in kind of separate moded spheres. I wonder if gold is up here today as a kind of reflection of, well, Xi and Trump didn't really break any ground. They just took a step back from a crisis of their own making and were basically reset to, let's say, September-ish. But nothing substantive beyond that actually occurred. Thoughts?
I mean,
yeah.
Go ahead, Thomas. Sorry.
Yeah, I think you're right, but I mean, overall, the trade is still going in the way of de-escalation. I think China, it was always going to be the sticking point where it was one of the last that's negotiated, and that's because of the complexity of, just the size of the economy and the trade we have. I don't think it's something that, even if it deteriorates a little from here, I don't think it's something that derails the market. I'm still going on my view that the overarching theme that Dylan has said a lot, that AI is fueling this market. I still think that's going to overcome any near-term fear from trade. And, you know, to bring up Apple again, it's up 4.5%. It's beyond 1% of its expected move. So, I mean, that's kind of showing, you know, if the market is in a fear mood and ready to, you know, sell off more, would a name like Apple be beyond its expected move to the upside on, you know, what looks like just a modest beat? So that's why my view is I'm getting long NASDAQ and I'm going to be long the equity market.
And just piling on to Thomas's point, for the millionth, billionth time, the prevailing dynamic here has been to buy these dips.
Yes.
But the trading,
clearly,
when you get fragility or sell-offs, it's not a situation where you should pile in and get short. It's a situation where you buy what you want to own cheaper.
Yeah. I mean, that has absolutely been the case so far. I mean, there's just no question. There's just no question. I mean,
so you know, if it ain't broke, don't fix it. I mean, I just don't see how that's not the higher probability decision.
I think it is the higher probability decision looking backwards. I don't think it's necessarily the higher risk or the better risk reward decision looking forwards. And I think that's really been the essence of why I have been kind of poking at the market whenever it seems to show a weak hand. And as we talked about, I mean, the moment Powell said the magic words yesterday, the moment he came out and essentially said, I know that I come out here every month or after every meeting, and I tell you all that the next meeting is not predetermined, and we're going to look at this and we're going to look at that. I am saying more than that here. You should not look at December as a foregone conclusion. Far from it. Wink, wink, nudge, nudge. You're wrong, markets. You should, in fact, he said, he's like, well, looking at the markets, looking at December as certainty, it's not a certainty, so that would be good to take on board. I mean, he was quite literally talking, it seemed like, to Fed funds futures traders going, you all need to stop it. And they have. So you look at this and you go, okay, from a risk-reward perspective, what do you do? I mean, the moment he said that and the markets fell, you go, in my mind, okay, maybe this is the one. Maybe it's not. Who knows? But with vol so cheap, you can take a little stab and see. And if you lose a little, so it goes. That's kind of the nature of what you're doing. When you're fighting a market like this, you're going to lose the first X number of trades because you're going to get rolled over, which is why you put verticals on the cheap and run away from them if the price action tells you you're wrong, as I have. So I did put on some SPY put verticals ahead of this, or ahead of today after Powell said the magic words. We'll see. I frankly was not expecting them to work at all today. We'll see if they stop working as of tomorrow.
I think if your view is that the AI narrative is going to continue to fuel the market, fuel spending, and you put yourself in the shoes of an executive who's making decisions on that spending, I don't think you're going to look at what Powell said and say, let's stop investing, let's slow this down. I think right now they're still going full steam ahead. I think that's going to push a lot of capital into the market. And
I agree.
I think we're going to forget about what Powell said by Monday.
I agree. I just don't make the same connection between what that executive is going to say necessarily. Maybe it's been the right connection. I just think there's a shelf life on the connection between what that executive is saying and what speculative risk capital does. And I think, were we not in a kind of now reflexively buy the dip type of an environment, there we would have long ago arrived at the place where the markets go, okay, we know those executives are going to do that. We know that this is a multi-decade build-out of capacity and investment and then ROI. We know all of these things, and we've known them for months. At some point, surely that's going to be priced in until we get the next kind of layer of macro narrative. The next kind of, this is here. This is the next thing. And by the way, this always happens. There's always this kind of, bubbles aren't created out of nothing. They're almost always created out of an overhyping of a very real thing that ultimately works and ultimately meets its promise, at least to a large extent. Railroads, cars, telecoms, whatever, the steam engine, America. All of them, obviously, things that ultimately worked. All of them were speculative bubbles on the way in.
For me, I'd rather ride the bubble until it pops and be wrong that once.
Yes. Yeah, in a very Soros-esque way.
For the market's speculative nature, I think there needs to be a trigger for something to tell the market that this AI narrative is derailed. And I think that's something like, margins start coming in a lot. The return on investment into AI doesn't manifest like it's projected to. And I think we're not even close to that. I think that's going to take at least into next year at the very soonest.
That could be.
So I'm taking, how the market's been going, and I'm just applying that going forward pretty much.
That very much could be. And there's certainly no shortage of evidence that this is what has worked so far. And with that, happy thought, overtime is out of time. Don't go anywhere, everybody. Macro Money will be on momentarily here after a short break, where we're going to dig into this price action and look ahead to what is coming next. We got some interesting testing of the waters next week with some third-party economic data, so we're going to unpick all of that. In the meantime, this show is done for this week. We'll be back on Monday for Dylan Radigan in Milan, Thomas Westwater in Chicago. I'm Ilya Spivak in San Francisco. Sit put, everybody. We'll be right back. After the Fed shocked everybody with a more hawkish outlook than the markets wanted. That's what's on the mind of everyone looking at what's happening here with Wall Street turning lower, even as we have more tech earnings in the wake. So, are we finally at that point where speculative appetite has given way? We're going to take a look at exactly what's going on and what might be coming in the week ahead. Macro Money starts right now. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And boy, did we have an interesting set of developments here over the past 48 hours. Needless to say, the big story has been the Fed, and it gave markets quite a bit of indigestion. So without spending too much time on a preamble, what we're going to do is dive right into what the results of that Fed shock were and attempt to figure out why it was that it was so shocking, what it did, and what the next big inflection point in this story is likely to be. So, first and foremost, here's what we saw today. And there's a number of interesting standouts here. We have obviously a down day for the sort of big indexes. S&P off almost a percent, NASDAQ off almost 1.5%. Yields up in the wake of what the Fed did and really what Fed Chair Powell did. Crude oil digesting. U.S. dollar up across the board, especially against the yield-sensitive yen. It's not quite as up against the euro, but of course there was an ECB monetary policy announcement overnight. They held rates as widely expected, signaled that really they have no intention of resuming cuts anytime soon. That wasn't exactly controversial. Nobody was expecting them to. In fact, the outlook in ESTR interest rate futures, the equivalent to Fed funds futures for the U.S., had the ECB on standstill through the end of next year. So no big controversy there. The euro bounced a little bit once the ECB confirmed as much, or at least their intent. Since then, of course, it's kind of skidded lower with the general dollar strength. Bitcoin off almost 4% around sort of this generalized risk aversion. Again, doing that whole stocks or risky assets on steroids thing. Wall Street sells off, Bitcoin sells off more. Couple interesting things to look at here. Obviously, this follows from what we saw yesterday. This is the immediate reaction after the Fed. We can see gold was down, dollar was up, Bitcoin was down, yields had a much more spirited jump in the immediate aftermath. Stocks were sort of neutral. And this is where this gets really interesting. Today, we can see stocks decided to follow through. No real retrenchment on the yields, no real retrenchment on the dollar. Gold has interestingly perked up. Bitcoin just keeps getting slammed. So, the most interesting sort of things in this price action that jump out at me is, number one, what in the world is gold doing up when yields are up and the dollar is up? That's typically kryptonite for gold. Gold is an asset that yields nothing, which makes it inherently vulnerable if yields go up, because why would you own something that yields nothing when you can own something that yields something? So when yields go up, the appeal of owning gold, at least from a speculative perspective, is diminished. Gold is also a kind of alternative to fiat, a kind of natural foil for fiat. The standby fiat currency, of course, the one that matters, the benchmark for all of them, is the US dollar. So when the dollar is up, well, you don't really need an alternative currency. And so when the dollar is up and yields are up together, that's speculative kryptonite for gold for obvious reasons. And yet here we are. So that's one thing. And the other, of course, is that stocks decided to sell off. Now, when we look at the price action dynamics, it probably makes some sense why they didn't decide to do this yesterday. So here's the initial response to the presser with Fed Chair Powell. Note, by the way, this sort of sideways bar before the red one, these are 15-minute bars, by the way. This is the actual FOMC policy announcement. This is where the statement comes out. And the markets very clearly say, yeah, okay, there was two dissents. One of them was bullish, one of them was bearish, or one of them was hawkish, one of them was dovish. Stephen Meehan wanted more cuts. Big shock, comma not. Jeff Schmidt of the Kansas city Fed didn't want any. Okay, so now we know who the resident hawk is. Okay. We got a bunch of language in the statement as we looked yesterday, and I will link that conversation, that episode from yesterday at the top here, so you can check that out. But the language was clearly sort of saying, woe is us, we don't have all the economic data that we need, but the markets didn't think that was really the meat of this. They thought, okay, well, fine. That's about what you would expect to hear. Just give us our rate cut. They got the rate cut. And then Powell opened his mouth. He got up and to the podium for the post-meeting press conference. And we can see what the reaction was right here. And we'll review in just a second what that reaction was all about. But clearly, I mean, without even thinking about what Powell said, clearly what he said upset the markets. And then the markets sort of reset back to where they started. And that same reset didn't happen in bonds. It didn't happen in the dollar. But it did happen here. So naturally, this kind of begs the question. And when you consider that after the bell yesterday, we had the first kind of big batch of top-tier trillion market cap tech earnings for the week, it sort of makes sense. Why in the world would a market participant want to lean heavily this way or that in front of earnings from Meta, earnings from Microsoft, earnings from Google? These are obviously huge, huge influences on where the overall market is going to go. And as it happened, Microsoft and Google had good results. Meta had a big miss. Microsoft fell anyway. Google rallied. Meta fell more. But that the markets would get defensive, at least as far as conviction goes, and say, you know what, we're not going to commit one way or another to this Fed thing until we see these numbers, that seems to track. But then overnight, you get a big rejection at the top of the range, and then you leak lower for the rest of the day. And this is perhaps where things are really interesting as well, because needless to say, today after the close, we had Apple and Amazon, two other big names. And so if the markets were reluctant to be convinced one way or another after the Fed, one might have expected them to be reluctant to be convinced today, and more so in digestion mode. But that's clearly not what happened. We clearly saw a negative response. I mean, there it is. So there is the gold rally, which seems to clash with what's going on in yields in the dollar. And then there's stocks ostensibly caring about incoming earnings calendar event risk and then not. Well, of course, we'll see what happens tomorrow, but the question stands. What was it that the Fed chair did then, if the markets ultimately decided, you know what, risk off? Here were his comments, and I think very clearly the thing to pay attention to is this last bit right here, where he said, there are different views about how to proceed at the December meeting, strongly differing views. A further cut in December is not a foregone conclusion. Far from it. And there was a really interesting dance that Powell did here. He came out and said, and this is a direct quote, "I always say that it's a fact that we don't make decisions in advance. But this, I'm saying something in addition here. A rate cut in December should not be seen as a foregone conclusion. In fact, far from it." Now, what's interesting about this, of course, is that when the markets went into this thing, they did think that a rate cut in December was a foregone conclusion. And after some kicking of the tires here overnight as the CME FedWatch tool was adjusting for all of this, this is the accurate new view. So here's the current rate right here. And we can see that going into this, so this was yesterday, the market saw single-digit possibility that rates would remain unchanged and well over 90% probability that we'd get a further cut into this 3.5 to 3.25 range. Well, clearly, this has changed now. And by the way, today is a little bit of an improvement on yesterday's shock response. But we can clearly see the likelihood that we would stay unchanged here has significantly increased. The likelihood that we will get this extra cut has significantly decreased. And of course, that echoes all of the price action that we see. That echoes the lower bonds and higher yields. It echoes the stronger dollar, all of those things. And it seems to sort of track from what the Fed chair and what really the committee was signaling in September. If we just take a look a little bit under the hood, here was September's projection. We can see here from a baseline of 4.4 before September's meeting, because again, the Fed is setting policy in ranges here. So we're looking at medians, right? This is the 400 to 425 basis point range, the 375 to 400 range, the 350 to 375 range. So, and these are single numbers. So the range, the median range before these rate cuts started in September for the Fed funds rate was 4.4, between 4.25, 4.5. Okay, so we get a 3.6 forecast. All right, what does that mean? Well, if we're in a 4.4 range and the number is 3.6, well, that's a difference of 0.8, which is just a rounding off of 0.75, which is 3 cuts at a 1/4 point each. 25 basis points and 25 basis points and then 25 basis points more. This forecast is issued when we are in September, and the Fed has already issued one with 2 meetings left. October, which we just had, and December. So clearly the markets here are at 3 cuts. Before they were at 2, 3.9. In fact, they held at 2, really since the beginning of the year, even going back to December of 2024, if memory serves. And so clearly we've got the 3 cuts here. That's what the markets had on their bingo card, and the Fed is clearly saying, no. And if we look under the hood, it's perhaps because this is what skewed the outlook. We're only narrowly at a median of 3 cuts, and probably because of this dramatic dot